Namaskar, hello and welcome friends to Finnovision, your one-stop solution for CFA exams. My name is Shushmit Aditya Mukherjee. I'm an educator and an investment research analyst, and this video is part of the full class series for CFA Level 3 curriculum. Hope you enjoyed this video. Let's get started.
So hello and welcome friends to this new chapter of CFA Level 3. This chapter is called Capital Market Expectations. Now here, this term has two parts. One is the capital markets and second is the expectations. So first let us understand what do we mean by capital markets. Capital markets is basically a place, a collective place where a meeting happens. Meeting between the capital providers and the users of capital. Capital providers means retail investors, HNI investors, institutional investors, debt providers, all these providers of capital who want to invest their money or lend their money, right? Then there are users of capital. Who are users of capital? It can be businesses, it can be individuals, it can be governments. What can be the users? Individuals can take loans for education, for some consumption, for business. Institutions can take loans for expansion, for business, for taking the benefits of leverage. Sovereigns can also take loans. They can take loans to do infrastructure projects, to do welfare, etc., to make up for the deficiency, etc., etc. So we have understood who are the capital providers and who are the users of capital, and both of them are overseen by certain entities who are called the regulators. Let's say for an individual taking a loan, the bank is the provider of capital, the individual is the user of the capital, and the regulator can be the government or the banking system. Now let's say an IPO is getting issued in USA. An IPO is getting issued in USA and there is an individual who is investing in this IPO. Now this individual here in this case is the provider of the capital. The business who is issuing the IPO is the user of the capital and the regulator is SEC. Another example can be, let's say a company is issuing bonds. Now, the company which is issuing bonds is the user of the capital, and the people who buy those bonds, who invest in those bonds, are the providers of capital. And obviously, the regulatory bodies which are guiding that entire transaction are the regulators, and these three primary bodies form the capital markets. Now, what are the things or what are the instruments through which these kind of capital market transactions happen? Majorly, these transactions happen to instruments like stocks and bonds, and apart from that, instruments like derivatives and commodities are also invested upon, right? Now the capital markets part is clearer for us. Now what is meant by expectation? The second question is, we know what is capital markets. Now what do we mean by expectations? So an example of expectation of capital markets can be, let's say you are looking to buy in Forex and there is a currency XYZ which you are betting against. There is a currency XYZ which you are betting against and you are actually long the US dollar, right? You think US dollar is going to appreciate in comparison to XYZ, right? So what you do? You sell the XYZ and you buy USD. You sell XYZ currency and you buy USD. That's what you do. Now this transaction you did based on certain assumption that USD is going to appreciate, right? This is what we mean by expectation. This can be against currency, this can be against commodity. Let's say you are trying to bet on oil, you are trying to invest in oil. Now you have to have an expectation of what is going to be the price of oil in the future. Let's say you buy at an X price and then you want to sell it at an Y price, right? Now the expectation for the Y you have to set, right? So this is called capital market expectation. Or let's say you are investing in a stock, you are doing swing trading in a stock and you are holding a stock for say, let's say 40 days. Now you expect that stock to go up 20%. This is another capital market expectation. From the point of view of an asset manager, let's say you are trying to create portfolio for your clients. Now you are trying to set expectations on both fronts. One front is, what are the goals of this client, and the second front is, where should we make investment so that these goals are fulfilled. This is also based on capital market expectations. You are first understanding what is the goal of your client, then you are trying to find out the asset universe where you need to invest for those goals to be fulfilled in the highest sense of probability. And this probability is based on certain expectations you have from those assets. Basically, you are setting expectations for capital markets. So this is what we holistically mean by capital market expectation. Now, setting of capital market expectation is a very intricate job if you want to go into the details. So what we'll do is we'll start with a framework for setting up capital market expectations, know what are the steps for it, then understand what are the limitations of it, and then take it further into more details and expand into how to create capital market expectation. So let's get started. Framework for developing capital market expectation. So there are 7 steps through which you can set up a framework for developing capital market expectation. Now, step 1 is specifying the set of expectations and the time horizons in which those expectations are going to be fulfilled. We'll get into the details and take examples. Just let us take the points first. The first is specify the expectations and the time horizons. So let's say you are thinking that a certain stock is going to rise 20% in next 3 months. This is the first step, setting the expectation and the time horizon. Let's take an example. Let's say there is a portfolio manager who is trying to make a prediction or an expectation on the stock markets, and right now the stock index is at 1000 points. Now the portfolio manager, based on his or her experience, makes this expectation that in 2 years time this index is going to go up to a point level of 1500 points. That is the expectation or the hypothesis, you can say, of the portfolio manager, right? Now the question is, what is the framework based on which such a conclusion can be validated? This is an initial hypothesis or initial intuition, you can say, about the markets that the portfolio manager has, but to confirm it there can be a framework which can be applied. So this is that framework which we are trying to understand here. So there are steps here. The steps are, the first step, specify the set of expectations and the time horizon. So naturally the portfolio manager thinks that the markets are going to go up by 50% over a time horizon of 2 years. See here, not only the quantitative expectation but also the time horizon is important. 50% in how much time? In 2 years time, right? This is the first step, specify the expectation and also the time horizon in which that expectation can be fulfilled. Now this is a basic hypothesis or basic premise from which the analysis starts. Now we have to validate it, we have to reconfirm it, we have to understand, make deeper interpretations into it and confirm it only when the validations are enough credible. The validations are credible enough. So for that the remaining steps come. What is the second step? The second step is research historical records. So let's say you are basing this assumption based on the market trends, based on the current market trends, right? So your first data point is market trends, and let's say to reconfirm it you go to the previous market trends of, let's say, the previous 2 years or the previous 3 years or the previous 5 years, and let's say your standpoint is either contrarian or momentum wise. Let's say you are saying that the markets have done very well for the previous 2 years and we do not see any deterioration in the fundamentals, therefore in the next 2 years also the markets will keep going up and this will be the result, it will be even better. This can be one of your conclusions. The next thing can be, you see that the markets have corrected for the previous 2 years. There has been a deep correction in the markets. Now you see the markets are highly undervalued, and based on that you say that the markets are going to go up 50% in the next 2 years. This can be based on, both these conclusions are possible. Now what makes this possible is not only the stock price trends but also certain other fundamentals, like what is the GDP, what is the current valuation or the P ratio of the markets, let's say the market cap to GDP ratio or the stock exchange's P ratio, then what are the interest rates right now, what is the standpoint of the central banks right now, what is the scenario of the economics, what is the geopolitical scenario. All these factors come into the historical records. Historical records means you go back in timeline and see what kind of geopolitical situations, what kind of interest rate scenarios, what kind of regimes, what kind of P ratios led to what kind of outcomes, and based on that and extrapolating all of that into the pricing factor, you come to a conclusion and validate, okay, let's say I thought it's going to go up 50%, but it's not going to go up 50%, maybe it's going to go up 70%, or maybe it's going to go up 30% or 20%, whatever that can be the conclusion. So this is the second step. The third step, specify models and information requirements, right? So let's say in the research historical record part, you checked 100 different factors. 100 different factors you checked, and from that you understood that correlated factors related to your hypothesis are only 25 factors, right? 25 factors are important. Let's say you understood many factors, 100 different factors. Let's say the CPI you understood, the interest rates you understood, the geopolitical scenarios you understood, the regime you understood, the political party who is in rule you understood that, the regulatory factors you understood that, the P ratio you understood that, the GDP ratio you understood that, the GDP to market cap ratio you understood that. Now then, after reanalyzing and revalidating all that, you see that the market cap to GDP ratio and the stock exchange P ratio both are redundant. You have to use only one of them. Another factor can be, let's say, which regime is there nationally is less important and the holistic geopolitical scenario is more important. So based on all these filtrations, you filter out from 100 factors 25 factors. So here comes the information requirement. So specify models and information requirement, right? So information from 100 factors, you filter it down to 25 factors. And based on these 25 factors, you also understand what are the risks and return possibilities, right? Based on these information requirements, you understand what are the risks and what are the return possibilities. Now, the return is the market return and the risk, let's say, is the market risk, right? Now, you want to create a model for equity returns. So let's say you have your risk amount, you have your return amount or expectations here, and you find out, let's say, your beta, and you create a mathematical model with which you will calculate the returns projected. You will calculate the returns projected based on that, right? So all these factors have been reduced into two factors. One is risk and one is return. Then you, let's say, you modify the risk into beta and then calculate the returns. This is basically creating the models, and obviously all these things have to be reasonable. They have to be reasonable. Let me write the word here. You have to have an explanation why each of these factors are important, and you also have to have an explanation that why you are using these numbers the way you are doing it. This is the third step. The next step, determine the best sources for information needs. Determine the best sources for information needs, right? So let's say you have done it from Google search. You have searched Google and you have found out these data. Now you are going much more granular. You want to know the correlations, want to know the actual beta numbers, you want to know the actual return numbers up to the daily basis. Let's say you want to know this daily data of stock markets, right? Now you are looking for high frequency data and data that has least biases. Now, when you are going for historical data, there are certain risks. There are the risks of survivorship bias, there are the risks of smoothing bias, there are a risk of data mining. All these risks happen with data, right? So you need to find out the particular sources which give you the best numbers and the most authentic numbers that are available, right? To make better assumptions or to make better calculations, you need those numbers, right? So that can be acquired from the best sources only. The higher the stakes, the more refined the data source should be. A little social media search or a search engine search may not be enough. You need to find third-party resources, credible, valid resources with good reputation, which can give you the best data without certain kind of biases. So this is determining the best sources for information needs. Okay. Then comes the fifth step. Fifth step is what? Interpret the current environment. So after you have got all this data, now you had made your hypothesis, you had created your model, you know what are the variables that are going to be applied in the model, you know the factors. Now all these factors, we spoke about 25 factors here, right? Now these 25 factors, you look at their current condition. let's say the interest rate currently is 5%, while the historic average interest rate is 2%. Okay. Now, based on this, you can set an expectation that the interest rates are going to go down. This is one kind of current environment understanding that you have. Next thing can be, right now there are high geopolitical tensions, but they are predicted to go down in the next 2 years. They are predicted to or projected to go down in the next 2 years, which can, from this you can actually imply that the business will be better, the trade situation will be better, the oil prices will be in a better condition, there will be less constrictions in import and export. Another example can be, let's say you find that the USD is appreciating a lot. The USD is appreciating a lot, which means imports can get cheaper and exports can get more and more costlier. Which means investing in international markets can be an option. But then you balance it with the factor that other currencies are also depreciating. So if I invest in a country where the currency is depreciating, I'll have to balance it. Let's say I invest in a country where the GDP is 10%, but the currency is depreciating at 5%. This means my net to net growth is 5%, 10 minus 5%, which is 5%. So these kind of current environment understanding you have to make. Then the sixth step is provide the expectations and the conclusions. So all these 25 factors that you found very significant, you have analyzed that, and based on that, maybe you have gone through your expectations once again and you have modified them, and you have said that 1000 points right now the markets are at 1000 points. It is going to go up to 1350 points, right? So you are saying in the next 2 years, previously you were saying that the markets are going to go up 50%, but now you are saying that the markets are only going to go up by 35% in the next 2 years. So you have modified your expectations a little bit. Now, the last and an important point is you monitor your outcomes. So let's say your model is saying that in the next 2 years 35% growth is going to happen. Now you compare that with the actual numbers. Let's say you predicted 35% growth, the markets grew by actually 40%. So there was a deviation here, and you try to analyze what were the events or what were the factors which led to this difference. Which factor led to this difference? You want to calculate that. Maybe they are within these 25 factors. Maybe you miscalculated one of those factors, or maybe you overweighed or underweighed one of those factors, or it can be any other factor that you did not consider. It can be some external factor, factors which are outside these 25 factors. So all these things you have to do. So we will revise the steps once again. First, you specify the set of expectations and time horizon. This is basically creating an hypothesis. Then research the historical records, which means you go through a set of data. Then specify models and information required. So once you have gone through the data, you are able to understand which are the information from them which are important, and based on that you apply a model on them to create your expectation. Then the model is selected and the information required is selected. Now you are going more granular and you want to find out the best sources of getting these data. So you have selected the factors for which the data needs to be collected. Now you find out the best sources to collect those data. So this is the step number 4. Then interpret the current investment environment. So currently, what is the environment? What are the geopolitics? What are the macroeconomics? What are the microeconomics? What are the technological aspects? What are the employment scenarios? All these things you go through once. This is the interpretation of the current investment environment. Then the 6th step, provide the expectations and conclusions. So here your hypothesis can get modified slightly or can remain the same, can improve or can degrade. Both these things can happen. 7th point, once you have made your conclusions, you monitor it and find out the deviations that are happening and try to improve your model. Why the deviations have happened? Did I choose the wrong factors? Did I overweigh the wrong factors? Did I underweigh the right factors? All these things you decide in the 7th step. This is basically improving the model. So this is what we mean by creating a framework for setting up your capital markets expectations. So friends, now we discuss what do we mean by data segmentation or data slicing. Okay. So once you have set your expectations, once you have set out to set your expectations, obviously you have a target asset set in your mind, right? It can be different kinds of assets, it can be one kind of assets with their subclasses, it can be different geographies, it can be one geography, right? It can be preferences of different sorts. Now we are trying to summarize how the data can be segmented in a very brief way. First, let's say you are looking to slice the data in terms of geographies. Now what can the classes look like? It can be classes in developed markets, it can be classes in USA, it can be classes in emerging markets, etc., etc. Then let's say you are looking at asset classes. Let's say you are looking at whether to invest in equity or in bonds or in real assets or in cryptocurrencies or derivatives or whatever. They are different asset classes, right? Now within the asset classes, let's say you select equities only will be investing in. Then in them your preference will be multivarious. For example, you may be preferring value stocks, you may be preferring growth stocks, you may be preferring small caps or micro caps, you may be preferring large caps or mid caps or micro caps or IPOs, or you may just be interested in private equity or venture capital. So all these options are basically subclasses of broader asset classes. Whether you want to invest in equity or bonds or real assets or other kinds of assets, it depends on the choice. Then in fixed incomes, there can be choice between senior securities, junior securities, collateralized securities, without collateral securities, high quality fixed income securities, low quality fixed income securities, mortgage securities, mortgage backed securities, etc., etc. Then you might also want to invest in real assets as in commodities, real estate, timber. So these are sub asset classes. So all these things have to be taken into account when we are looking at creating an asset universe or creating a portfolio, that these are the assets I want to invest in, and within them these are my preferences. I prefer only value stocks, or I prefer more growth stocks. I prefer emerging markets more. No, I prefer developed markets more. No, I prefer senior securities because I prefer when I'm investing in debt, I want more security. So I prefer senior securities, right? So these are ways to segment data. Now we'll talk about limitations of data, as in limitations of historical data. Now let me tell you an example. During the 1970s, something very unique happened. The gold standard was converted into a fiat currency standard, right? Currently, whatever currencies we are using, they are not gold backed, and it happened during the time of President Nixon of USA. And what ensued after that was huge amounts of inflation, and inflationary pressures forced the central bank, namely the Fed, to increase the rates. And at that time, at the helm of everything was Mr. Paul Volcker, and he is said to have taken the interest rates right up to 16%. If you see the historical data, I am not exact on that maybe, but he took the rates right up to 16%, and that was the necessity of those days. The Fed thought it necessary to bring the rates up to those levels. And the reverse thing happened during Alan Greenspan. Alan Greenspan brought the rate down for the first time to such close levels to zero. It was called near zero level interest rates, and they had certain other kinds of repercussions also. Now if you try to compare the stock market data in these two regimes, now if you try to compare the inflation data or the interest rate data or the stock market data, stock return data during both these two regimes, you are likely to find startling differences. Now comparing these two databases will be unfair if you do not consider the interest rate regimes these data are under. So herein comes the role of the regime. During different regimes, the mean is different, the volatility can also be different, the highs and lows can also be different, right? Let's say if you're talking about interest rates, that during Paul Volcker, the interest rate could have ranged between 16% and maybe 5%. This could have been the range. On the other hand, during Alan Greenspan's period, the range could have been 0.25% to 5%. That is, the top level would have been 5%. I'm not exact on these numbers. I'm just taking examples to make you understand that the ranges, the means, the volatilities, everything differs with the regime, and generally it's the regime of the regulatory bodies or the geopolitical scenarios or the political scenarios. So you have to take into account all those factors, and obviously the macroeconomics also form part of the regime to a certain extent, right? Now, during different regimes, the data behaves differently, which means there is non-stationarity. This is our second point. Differences in regimes, differences in the fundamentals during different regimes leads the data to have something called non-stationarity, which means the means become different, the mean becomes different, the volatilities become different, and if you standardize the data behaves quite differently. The distribution is different in both the cases, right? So these are two of the limitations. So regime and non-stationarity are limitations of historical data. If you do not take into account the regime and the non-stationarity which ensues out of it, then your analysis can be mistaken, right? Now one may think that to make the data more precise or make the calculations more precise, a higher frequency data may help. Now that, although apparently seems right, but ultimately in the long run, when you are trying to estimate the markets or create expectations of capital markets, this may not be always true. For example, let's say in a market there are different phases. There is the recovery phase, there is the expansion phase, and there is the peak phase, and there is the contraction phase also, right? Now let's say an analyst analyzes a market which is actually in a peak mode, and mistakes it to be in expansion mode, right? Therefore, the expectation setting itself will become wrong. The analyst would think that the market would go up further for next couple of years or 3 years or 5 years or whatever, and accordingly the analyst would make the predictions and projections, and accordingly the selections will be made. Let's say if the analyst had correctly assessed the markets, then he or she would have understood that the markets are in peak scenario and chosen more of certain assets like high quality government bonds, right? Government bonds are generally considered high quality bonds. So the analyst would have chosen this kind of an asset. But he or she thinks that it is in expansion mode, and instead of choosing more government bonds, the analyst chooses more growth equity. Now, there is a problem here. You cannot expect to make better predictions based on high frequency data if your assessment itself is wrong. Now here in this case, whatever analysis with high frequency data the analyst does, chances are that the portfolio will not do so well, right? Even if the analyst chooses high frequency data, very high frequency data with no biases at all, then also there are chances that this portfolio would not perform well just because the assessment is wrong. In statistical terms, it says that the precision of correlations and volatility can be improved with high frequency data, but it cannot change the data mean. It does not impact the mean of the data, right? The mean of the data, or the X bar, is not that much impacted with the frequency. The correlation is impacted, the volatility can be impacted, but the mean is not impacted that much by the high frequency data. Therefore, if you're trying to make better predictions, if you're trying to set better predictions or better market expectations, more precise market expectations, then the assessment matters much more than the frequency of the data. And there is one more problem of high frequency data, which is asynchronicity. What do we mean by asynchronicity? The more frequent the backward looking data is, like the historic data is, the chances are that these data had been filled up in an untimely basis. Let's say you are looking at quarterly results. And based on that, you are trying to understand the stock price behavior, right? Now you are looking at a 30 years quarterly results data, and trying to assess the correlation between the stock price and the quarterly results. Now high chances are that these quarterly results would have been declared a month later or 40 days later or 21 days later, like this, right? But historically speaking, if you have taken a data which is high frequency, instead of annual data, you're looking at quarterly data. I'm just comparing. Compared to annual data, quarterly is more frequent, right? So there is a higher chance that you will have more data which are not synchronous with the time. The price and the results are not simultaneous. There are more high chances. On the other hand, if you look at a less frequent data, for example, instead of quarterly results, you look at the 10Ks or the annual reports, then there are 30 chances. If you take a 30-year data, there are 30 chances of you having little bit of mistiming in terms of the pricing. There are 30 chances. In case of the quarterly data, you have 120 chances, right? In case of the quarterly data, you have 120 chances of asynchronicity. So it is less asynchronous, less frequent and less asynchronous. So this is one of the factors. This is one of the factors when you are looking to create timing correlations, time related correlations. Asynchronicity becomes a very important factor, and high frequency data often has this bias of asynchronicity. Then comes the point of data quantity. Now what do we mean when you're talking about data quantity, right? Let's say in our previous example, you concluded that there are 25 important factors. 25 important factors that influence the market assessment. The current scenario of market is well defined by 25 variables or 25 factors. Now let's say instead of analyzing the macro scenario, you are looking at analyzing stock prices. Analyzing stock prices, and that also in a quantitative environment. You are doing a quant analysis. And based on this analysis, you find out that there are 500 different factors. 500 different factors which actually influence the prices of a stock, right? 500 variables now you have. Now, in terms of data points, you have only 100 data points. You have only 100 data points. That is 100 different cases of 500 variables. To make it simpler, your data has 100 rows and 500 columns. So there are 500 different features you are trying to define, but each of them has only 100 examples or 100 cases of study. Now this kind of scenario may lead you to have huge amount of underestimation of volatility of data. Huge amount of underestimation of volatility of data. The sigma may be hugely underestimated. It can be underestimated to the levels of near zero, and this is going to be spurious. So data quantity is very important, and here the main point that I am trying to say is, if you have 500 variables, you better have at least 500 instances or 500 rows, 500 cases. You cannot have 100 data points and 500 variables. This is not a good way to go. You should have 500, 5,000 or 50,000, or the more the better, right? The more the data you have, the less chances of you statistically making spurious conclusions. Now there are ways in which you can analyze data with thousands of variables and a few instances. That is done in machine learning and artificial intelligence. There are ways to do that. But statistically speaking, if you are looking to do quants analysis, it is always better to have a lot more instances than number of variables, right? Then comes the question of data distribution. What do we mean by data distribution? Let's say you are trying to analyze stock prices or stock index prices from years 1999 to 2004. Now here there are high chances that you have a negative skew of information. High chances that your data will look like this. On the other hand, let's say you are looking at analyzing the data from 2004 till 2007. Here there are high chances that you will have a positive skew. Data might look like this, right? Now both these data have different timelines, and because of that the distribution varies. Now let's say you have chosen a data which has positive skews and negative skews, fat tails and thin tails both. So you have kurtosis of both kinds, skewness of both kinds in the same data, and you have not considered the timeline differences which make these distributions different. For example, you have not distributed the data into different regimes or different market scenarios, and you have analyzed the data as a whole. You have just taken the data single piece and analyzed it and made conclusions on it. High chances are you are going to make wrong conclusions out of it, because different regimes, different market scenarios, whether it's a recovery scenario or the correction scenario or expansion scenario or peak scenario, high interest scenario, low interest scenario, high inflation scenario, low inflation scenario, all these things will matter very much when you're trying to understand the distribution of a data as a whole. It is very important that you segment the data based on consistency of the regime, consistency of the market scenario, consistency of the inflation, consistency of the interest rates, and other factors which influence the markets. So this is the next factor, and these are the limitations of historical data. The longer you go, the more different kinds of regimes you go through, the more different kinds of market scenarios you go through, and finding out averages of those variances become very much spurious. So it is very important you understand the current environment much more than the historical data of 100 years, right? Data errors and biases. So what do we mean by data errors and biases? There are three kinds mainly that we will discuss here. The first one is a transcription error. Transcription error is basically human error or machine error, or you can say, if it's a human error, you can call it a silly mistake, that somebody inadvertently put some data at the wrong time or put some wrong amount. Somebody made an error in terms of the time or the amount or both. So let's say the price at the end of day 3 of your data is showing 100 of a stock XYZ, let's say. Now actually let's say the price was 105. So this is an error in amount. Another way this error can happen is the data says it's day 3, but actually it was day 4 when the price was 100. This could be the case, right? Or other case can be that both the date and the time are wrong. So these are transcription errors. These are errors in recording the data. Then comes survivorship bias. Now, let's say you are investing in small cap stocks. And to understand the performance of small cap stocks, you are taking reference of the small cap index, small cap stock index. Now that says the annual CAGR is 35%. The annual CAGR is 35%. But it does not show that there has been deletions and additions in the index itself. Many of the stocks which were there in the index 10 years back, 20 years back are not even in the business anymore. So this has survivorship bias. It does not include the information that many of the stocks which were there in the index are no more there in the index. But you are going to invest in individual stocks, so you have to include that factor. And let's say after including survivorship bias, you find that it is not 35%, it is actually 15%. Then you are in a better position, more informed position to make the decision that if I invest in small cap stocks, the risk, let's say it's 25%, and I'll be getting a return of 15%. And if I invest in large cap stocks, the risk can be much less, it can be 15%, but I'll get a return of, let's say, only 8%. So this choice now you have, and you can make the choice in an informed way. If you remove the survivorship bias, this can be done. Then comes appraisal bias. This is also called smoothing bias. Let me write it, smoothing bias also. Smoothing bias. Now this happens if you try to create indexes or charts out of transactions which are infrequent. And this is very often happening when you're trying to create real estate price indexes, right? They have smooth data because transactions are infrequent. Let's say in a micro market XYZ, in the last 1 year, only 20 transactions have happened. And that also the properties are of different qualities, the sizes are different, the neighborhood is different, the pin codes are different, etc., etc. The amenities are different, the configuration is different, etc., etc. Now in this case, making comparisons becomes very difficult, and you want to smooth the data in applying different methods, and this creates an artificial sense of low volatility. Basically, so what smoothing does is it removes the chunkiness or the spikiness of the data and makes it smooth. And when you are looking at the data, you are seeing that there is much less volatility than there actually is, right? So this is one of the things that happens in case of appraisal data. This can also happen to high frequency data if the volatility is very high and you are looking at moving averages. Let's say you're trying to analyze the movement of stock prices over a period of 1 year when the VIX was very high, volatility index was very high. Let's say it was 30%. And over this 1 year period, you're trying to judge the index, based on 200-day moving average. Now there are high chances that you will make conclusions which are not appropriate. So this is called smoothing bias. So this can happen in stock market data also, right? So what we are doing here is we are trying to understand the different pitfalls and the ways mistakes can be made when we are trying to understand historical data, right? So one, we understood high frequency data, then we understood the regime problems which leads to non-stationarity, then the quantity of data where we are talking about how many variables you may have, where we are talking about how many variables against how many data points you must have. Then we talk about data distribution, and that depends on market scenarios, regimes, geopolitical scenarios and all those things, inflation, interest rates, etc., etc. All those things we have discussed. Then we speak about certain data errors and data biases. Data biases means which kind of biases? Survivorship bias. Is it a data biases in the data? Then smoothing bias. Here the bias is in the data. Then transcription error. It's an error of recording the data, right? Now there are other biases also, psychological biases, emotional biases. We'll discuss them in the next section. But now we'll talk about ex ante versus ex post expectation. What do you mean by that? Ex ante versus ex post expectation. So here, what do we mean by ex ante and ex post? Ex ante means it is in the future. We are just predicting it, right? And ex post means it has already happened. It has already happened in the past and now we are trying to analyze it, right? Ex ante versus ex post. Now this has expectations of the future, whatever expectations are there of the future that actually impacts the actual events, right? That actually impacts the actual events. Let me take an example. Let's say there is a rumor that a bank is going to go bankrupt. Bank is going to go bust. Now people start running towards it and taking out their deposits. People rush towards the bank and take out their deposits. Now what happens because of this is the capital ratios go haywire and the bank, even if it was not supposed to default, it actually defaults. Now this is called self-fulfilling prophecy. Let's say a currency XYZ, a country ABC has a currency XYZ, and people of this country ABC have lost trust in the policymakers and they have lost trust in the currency also. Now what can happen is this currency can get into a spiral of hyperinflation. 10%, 20%, then 50%, then 100%, then 1000%. This can be the way inflation numbers can come out. Once people lose trust in the currency, these are the numbers that can come out. And this has happened before historically in multiple scenarios. So this is another kind of self-fulfilling prophecy, you can say. So what is happening here is people are expecting some event. People are expecting some event A to happen. People are expecting some event A to happen. And because of that, they are taking certain action. So people are acting based on this expectation. Actually, this action is causing the event. This action itself is causing the event, and to either the event or the exaggeration of the event. Now this brings us to the peso problem, because we are talking about Argentina here, right? Now what happens in a peso problem is you underestimate the risk of the future. You underestimate the risk and you overestimate the return. And based on this, you set up your expectations. And ultimately, in the future, you see that the risks were much higher. The risks were much higher, and probably the returns were much lower. So this is called the peso problem, where you underestimate the risk in the future and overestimate the return in the future, right? Then we will talk about a reverse scenario where the risks are overestimated. Risks are overestimated, and therefore obviously the returns become of less utility. The utility of the returns become less because you have overestimated the risk. Let's say you try to analyze stock market data. You try to analyze stock market data of 3 years, 2 of which are 2007 and 2008. Right? Now it is highly likely that you will overestimate the risk. You will overestimate the risk and hugely underestimate the return. This is the reverse case of peso problem, right? This is the reverse of peso problem, where you are overestimating the risk and underestimating the return. Now we spoke about data biases and data errors. We spoke about peso problem and the reverse of peso problem. Now we'll talk about method biases. Analysts can sometimes be biased in their methods. Now, those biases can be majorly of two kinds. One is data mining bias. Let's say an analyst is trying to create a quant model which will predict the stock prices, and it has 100 variables in them. 100 variables in them. Now, it may so happen out of these 100 variables, 10 of them actually do not have a reasonable relationship with the stock prices. They are just there because some data mining biases happen. Which means the values themselves show some relations, maybe. The values apparently show some relation, and the analyst has gone on finding out every factor that had some numeric relationship with them. But there is no logical relationship perhaps. Fundamentally, maybe there are no relationships, but still the values, if you take the values together, they seem to have some relationship. And the analyst has gone on analyzing different factors and different factors and different factors till he or she has found out 100 variables, and obviously has ended up with 10 variables which do not have any logical or reasonable relationship with the price, although numerically they may seem to have some relationship, right? This is called data mining bias. Then time period bias. We have attended this before also. This is related very much to the regime and the market scenarios, assessment of the market scenarios. Let's say you are trying to create a market projection based on recovery phase, but the phase is actually expansion phase. So you are going to make mistakes probably, right? Or let's say you combine a high interest rate regime with a low interest rate regime and try to analyze both the markets together in a single database. There also chances are errors will be made. So this is time period bias. And one word you have to remember here is regime, or another word you can remember here is non-stationarity, right? This is time period bias. So these are analysis related biases. Now, because we are talking about biases, we will understand the correlations later, and we'll talk about other kind of bias which is called the psychological biases. Anchoring bias. Anchoring bias is basically sticking to your first set of conclusions or first set of interpretations. What do we mean by it? Let's say an analyst made a conclusion on the markets that it is an expansion phase market. Right now an expansion phase is going on, and he or she made this interpretation based on three factors: the data on profits, the data on GDP, and the non-performing asset data. These three factors were only included here, right? And the conclusion was this is an expansion phase. But then some other analyst suggested this analyst that you also take into account the data like the change in interest rates, the employment rates, the inflation data, the geopolitical scenario, etc., etc. These factors you also incorporate in your analysis and then create your expectation or conclusions, right? Anchoring bias means this analyst is not able to incorporate it in the proportion that is required. This analyst is very much anchored to the previous conclusion. So the analyst makes a conclusion previously that the market growth rate would be 20% in the next 1 year. After adding these factors, he or she concludes that it's going to be 15%. Growth will be there, it will be 15%, not 20%. So he or she is not able to understand that this can actually be a peak scenario which can lead to a contraction scenario. He or she is not able to figure that out because there is anchoring bias. Anchoring bias means your first set of hypothesis, your first set of analysis, you are just anchored to it. So anchoring bias means anchor to the first. Here let me write the word first. Anchoring means first information or first conclusion or first hypothesis that the analyst has or that the individual has, he or she is just biased towards that, not willing to make changes to the first assumption. Now, then comes status quo bias. Status quo bias means you don't want to change. The conclusions may have to be changed based on recent events. Status quo bias means change is painful. Change makes one sad. This is what status quo bias means. Let's say a quant analyst created a model based on 500 variables. Now, some other analyst or some supervisor comes and says that these 500 variables are not accurate. Only 300 of them are accurate, and you have to incorporate 400 more variables which are different. 400 more variables, mathematical variables, which are different than the 200 that you have incorporated. So get rid of the 200 out of this and add these 400. Now this is a huge change that the analyst needs to make. And if he or she doesn't make this change even after the supervisor saying so, then there is a status quo bias. Right? Another example of status quo bias can be bias towards recent events. So let's say in the last year, the market has grown 20%, and your conclusion is this year also, that is the next 1 year also, the growth is going to be 20%. But it might be that the market is in the cusp of change in the cycles. Maybe the peak is turning into contraction cycle, or maybe the recovery is turning into an expansion cycle. Both these changes are difficult to assume if you have status quo bias. So two things related to status quo, two words have to be remembered. One is change is painful, and second is recent events are more important. These two things combined together form the status quo bias. Now we come to confirmation bias. What do you mean by confirmation bias? Let's say an investor starting investing during 2022, and all he or she has seen is upward movement of the markets. Now it is 2025 and the market scenarios have changed. The interest rates are signaling it, the geopoliticals are signaling it, the unemployment rates are signaling it, maybe the NPA rates are also signaling it, the supply demand equations are signaling it. But this investor has only seen from 2022 till 2024 whatever has happened, right? And whenever somebody tries to put in the contrarian probability that the markets may have reached the peaks, then the investor goes back to the initial information which confirms the investor that this is an expansion market, right? Now what can the investor look into? The investor can look into last 3 years historical performance. This information alone, if the investor sticks to, then he or she can keep going on with the conclusion that this is an expansion market, right? So here we have a confirmation bias. What is happening here? Investor has a belief. The word is very important. Belief. And he or she is not willing to see data which contradicts the belief. He or she is not willing to contradict the data which he or she is not willing to even look at the data which contradicts this belief. He or she is too much attached to the belief, right? This is called confirmation bias. The one word you have to remember for confirmation bias is belief or conclusion. Let's say we can also call it conclusion. Already conclusion is made. Whatever analysis we are doing is basically to confirm the conclusion, right? Conclusion is already made. We're just going to look at the data which confirms this conclusion. Now this is a great way to remain biased, and this is called confirmation bias. Then we'll talk about overconfidence bias. What is overconfidence bias? Now, overconfidence bias is being overly confident on the judgment of one's own analysis. Let's say there is an analyst who has made great numbers in the last 10 years, right? Which is great. Now, the last 10 years, there were certain market scenarios from 2015 to 2025. There were certain market scenarios and the analyst has performed brilliantly in those times, which is great. But the next 10 years, things are quite different. The technology levels are different, the interest rates are different, the geopolitical scenarios are different. Now, if the analyst is not willing to incorporate changes or look at new things to learn, for example, what are the new changes in technology happening? What are the new geopolitical equations happening? What are the new interest rate scenarios that may impact the markets? All these new learnings, if the analyst is not going to learn. Now, if this analyst is overconfident that whatever judgments the analyst is making is going to be 100% foolproof. Now, this is called overconfidence bias. Here, what is happening is two kinds of things are happening. One is known unknowns are not being analyzed. Known unknowns means the analyst knows that there is change in the AI landscape, there is change in the technology landscape, there is change in the geopolitical landscape, there is change in the interest rate landscape. These things the analyst is not willing to learn that much because he or she has done brilliantly in the last 10 years. Their learning appetite has reduced and their confidence has grown maybe beyond the point it is necessary, right? This is called overconfidence bias, means you are not willing to analyze and reassess the known unknowns. Then there is unknown unknowns. There is unknown unknowns, right? We kind of know that how AI can impact the employment, right? How AI can impact the employment rates. But we do not know many other impacts which can implicate from AIs, right? We know how they will impact employment. We know that they will impact employment. We know that they will impact how we do things. We know how they will impact automation and all these things. But we do not know overall how many ways AI can impact us, right? How many ways AI can be used. This is called unknown unknowns. We do not even know what we don't know. What are the other factors that we have to know? We do not have the questions with us. Forget about the answers. Now, these things are also not being analyzed. These two things are very important for an analyst or for any person to keep on learning. Now, if somebody is less willing to learn and more confident on their own judgment based on whatever their previous performance, their existing knowledge, experience, or whatever, they are willing to learn less. This means they have overconfidence. They are not willing to admit that they can be wrong. They are not willing to admit that they can be wrong. Not admit to others, that is different thing. They are not willing to admit to themselves that they can be wrong. So this is called overconfidence bias. Then comes prudence bias. Let's say it is 2025 and a research analyst is making an analysis on the markets, and he or she decides and he or she concludes that the markets may correct up to 40 or 50% in the next 1.5 years. Let's say the analyst makes this. Now he or she has to share it with their supervisors, with their clients, etc., right? Now all of them have invested money. Now he or she does not want to freak all of them, right? He or she does not want to freak all of them. He or she wants to create normalcy as it is. Now what she does is, she goes back to her model, changes the parameters or changes the inputs or the model itself or whatever, and comes up with a new conclusion that this year the growth is going to be 5%. Now look at this. Her original analysis said that the degrowth will be 50% or 40% or whatever. There will be a degrowth, negative growth. And in the report, she modifies it just to sound normal. She modifies it and says that the growth, not the degrowth, the growth will be there and it will be positive 5%. So this kind of activity falls under the category of prudence bias. You want to look sane basically. You want to look sane or normal or regular. You do not want to ruff the feathers of somebody or make somebody panic or make somebody freak out. Although your analysis is saying that some freaky event is coming, right? The reverse can also be true. Let's say your analysis says the growth will be 50%. This year the growth will be 50%. But recently the markets have gone through a crash. They have crashed maybe 40-50%. So you want to sound normal. You reduce it. You tone it down and say the market growth will be only 10%. You tone it down from 50% to 10%. This is also prudence bias. So both ways it is true. Now we talk about availability bias. Let's say the first time you invested in stock markets was 2006. You invested in stock markets in 2006. And by 2008, your portfolio went down 50%. Your portfolio went down 50%. So in 2 years, your portfolio went down 50%. And the previous highs of 2006 were reached in 2010, let's say. In 2010, the previous highs were reached. Now, you have a very different idea of the stock markets. Let's say somebody else invested in the markets in 2012 and till 2018, he or she remained in the markets. He or she has a very different idea about the markets. Another example is, let's say somebody invested in the stock markets for the first time in 2022 and remained in the markets till 2024. Now, he or she has a very different idea about the markets, right? Let's say the first case is investor A, second and third cases are investor B and C. Now B and C have a different kind of impression about the markets and A has a very different kind of impression about the markets. Now if this impression is the dominant factor whenever they're investing in the markets, then they have availability bias. That is, whatever has impacted them much more, for investor A, it was the stock market crash which impacted him or her. For B and C, it was the stock market expansion which impacted them. So if A thinks that stock market is a bad place and you should not invest in it and your money can go down the drain, there is 50% chance or 80% chance of it, then A is having availability bias. That is, the information which impacted A the most has become the universal idea for A. Although generally speaking, stock markets have done very well over the longer periods of time. Let's say from 2000 till 2020 or 2024, stock markets have done exceedingly well, right? So A is not very appropriate when if he or she says that there is a 50% chance of losing money. There is 50% or 80% chance that you will lose 50% of your money. A is not appropriate in that calculation. Similarly, if B or C thinks that market corrections are a myth and they generally tend to not happen, then B or C are also having availability bias. Their own impression or the experiences that they had during their investment period are overly biased or overly influencing their decision making, right? Availability bias means things that have impacted more. Impact. Whatever events have impacted the investor more or the entity more is more important. This is a bias because you have to look at the entire data. You have to look at the contrary data also. Also, one other factor can be easy recall. Easy recall. Obviously for A, the easy recall is the 2007 crash. For B and C, the easy recall is the market expansion during their investment period, right? So easy recall can be another factor. Impact and easy recall. These two are the words to remember if you are trying to understand availability bias. Prudence bias means toning down. Toning down analysis to normal numbers. Quote unquote normal numbers, right? To not look freaky or to not freak out somebody else. This is prudence bias. So key words you have to remember here. Prudence bias means you are desperate to be seen as a normal person. Availability bias means you are impressed by certain events and you are overemphasizing them when doing analysis. They are easy to recall, they have impacted you more, so you overemphasize them when you take decisions. This is availability bias. Now we'll move into the next section where we'll talk about model and model uncertainty. So what do we mean by a model? Let's say a quant analyst creates a quant model which has price predictor. So the price of a stock P is predicted by 100 variables. Predicted by 100 variables. The equation goes like this. Theta 1 x1. x1 is the first variable. Theta 1 is the first parameter or the first weightage. Theta 2 x2. Theta 3 x3 till 100 parameters and 100 variables, right? So here thetas, let me tell you once again, here theta is the parameter and x's are the variables. X's are the variables. Thetas are the parameters or the weightages. Now what do we mean by model uncertainty? Model uncertainty means that this equation that has been created itself could be wrong. This equation itself could be wrong. Instead of being a linear equation, it could be an exponential equation. What do we mean by that? Here we have written a linear equation. Like P is a function of x1, x2 till x100 and all of them have to the power 1. x1 means x1 to the power 1. So their highest power is 1. All these variables, their individual highest powers are 1. So we are calling it a linear equation. But actually, the relationship of a few variables could be exponential. For example, let's say out of these 100 variables, 90 variables have linear relationship with the price, right? Another 10 variables can have exponential relationship with the price, which has not been captured in this equation. They can be exponential in relation. So this is model uncertainty. That is, the model that you have created itself could be biased or could be wrong, right? Then comes parameter uncertainty. So here the equation is P is equal to theta 1 x1 plus theta 2 x2 plus theta 3 x3 till theta 100 x100, right?
Now, what do you mean by parameter uncertainty? Parameters are which ones? The thetas. These are the parameters. Now, it might happen that thetas, some of the thetas have been overestimated, that is, the value is higher than what it should be. Some of the thetas have been underestimated, which means the value is lower than what it could be. Some of the thetas could be inversed. That means the relationship is negative, but you have added a positive. So all these things can be there, and all these things could happen actually. This is called parameter uncertainty, that you have chosen the parameters in a wrong way, maybe in their value, maybe in their sign or whatever. Then comes input uncertainty. Input uncertainty means you have created the model based on certain analysis of data, right? You have taken a data and based on that you have created this model. P is equal to f of 100 variables, right? Which we discussed previously as the example. Now this data has certain inputs in them. Based on them this model is created. So this model itself is dependent on the inputs. Now input uncertainty means this input data based on which the model has been created itself could be filled with errors. This is what input uncertainty is, right? So 2008 financial crisis was a classic example of model going wrong. Parameter uncertainty, will not take specific examples of parameter uncertainty. Actually you can correct them through various statistical means, like you can correct them through estimation errors also. This is correction of parameter uncertainty. Input uncertainty, obviously you have to choose the inputs and correct the inputs in a certain way so that they do not have the biases and errors. That is also a solution. Obviously among them the most significant is the model uncertainty. If the model itself is flawed, then the conclusions will also be flawed, and based on them, if financial products are disseminated, the results can be flawed.
Market cycles and trend growth rate. So what do you mean by market cycles, and what is the relation between market cycles and trend growth rate? Let's understand that, friends. Let's say we are looking at a 100-year horizon of the GDP of a country. Let's try to plot 100 years of GDP of a certain state or nation. Okay, let me draw the horizontal axis which represents the timeline first. Let's say this is the 100 years of timeline, and the vertical axis, let's say, talks about the GDP, right? Year on year GDP. Now let me calibrate it also. The horizontal line is in tens of years. The horizontal line, let's say, is in decades. So 10, 20, 30, 40, 50, 60, 70, 80, 90, 100, like that. 80, 90 and 100, okay? And the vertical plot is, let's say, in trillions. So 0.5 trillion, 1 trillion, 1.5 trillion, 2 trillion, 2.5 trillion, 3 trillion, 3.5 trillion, 4 trillion, 4.5 trillion, like this. So let me value the numbers here also. Let me put the numbers here also. So 10, 20, 30, 40. So here we have the time here on the horizontal axis, and on the vertical axis we have the GDP in trillions. Trillions of dollars, right? So this is 0.5 trillion, then 1 trillion, then 1.5 trillion, then 2 trillion, like this it goes. So till 4.5 trillion we have plotted. Now let's say if we plot the actual GDP numbers of the nation, the line may end up looking something like this. So this is the 100-year growth line which is formed by plotting each of the annual numbers, let's say. Let me put it from the beginning itself. Okay. This is the line how it looks like. Now here you can see, if you look at the entire line, there is not much shift, right? Now here you can see the entire line looks quite smooth and trending, right? Till this point, till here, let's say 90 years, the trend growth looks very much similar. After 90th year, it has steepened a little bit more, right? This has happened. Now this long-term pattern, you can call this the trend. So here the 100-year pattern is called the trend. Okay, you can call this the trend. Now, can the trend change? Yes, but it takes usually a lot of time for this kind of change to happen. And specifically, change happens in emerging markets. Developed markets have very stable trend lines. Okay, so this line resembles an emerging market state where from the 90th year some structural changes may have happened for which the growth rates have steepened. This is just an example. Now, if you zoom in at any section of this line, let's say we zoom in here, you might see there are small curves here also, right? So let me zoom it. Now if you zoom it, the figure may look something like this, right? So there is an waviness here. It's not just a smooth trend, but the wave patterns are also there. Now this is what we mean by coexistence of trend and cyclicality. Cyclicality basically focuses on shorter term cycles. It can be 3-year cycles, 1.5-year cycles, 10-year cycles, but still they are shorter than the entire trend level growth patterns, right? Depending on what kind of cycle we are talking about, are we talking about stock market cycles? Are we talking about business cycles? Are we talking about real estate cycles? Are we talking about supply and demand cycles? Are we talking about stock market cycles? Are we talking about currency cycles or behavioral cycles, or you want to just do swing trading over 3-month periods? All these things will change the cyclicality that you are looking for. But overall trend over the long term is very much reliable unless there is some huge structural changes that are happening at a policy level or a geopolitical level or something like that, or a currency level, something like that, right? So this is the difference between the cycles of the market and the trend growth rate, right? The cycles of the market and the trend growth rate. Basically, the trend growth rate is a straight line, seems like a straight line on which there is a waviness drawn out by the cycles of the market. This is how the market tends to behave, right? So here, market cycle means we are talking about shorter terms, maybe 5 years or 10 years or 3 years or 1 year. These are called market cycles. Now, these kind of changes may be smooth, maybe less, or maybe very drastic, right? Now, drastic changes basically happens due to certain kind of shocks or certain kind of systemic weaknesses that build in over a period of time. Now, all these things together, we tend to call them exogenous shocks to growth. Exogenous shocks to growth. Now, what are the primary reasons for these kind of shocks to happen? We will talk about them one by one. The first one is policy changes. Let's say the entire economy of a state was till now dependent on oil and gas. Oil and gas was the primary fuel driving the vehicles or driving the transportation of the entire economy. Now, due to certain policy changes, the stress has shifted to renewable energy. The stress has shifted to renewable energy, and renewable energy is getting subsidies, they are getting less taxation, and on the other hand, oil and gas are getting more and more policy constraints, the taxes are rising, etc. etc. Therefore, what can happen is the existing business structure, if this is done too drastically, the existing business structure may get hampered for a certain amount of time. And this is one way that the policy changes can impact the markets. Another example can be, let's say the agri industry is dependent very much on inorganic fertilizers. Now, the policy is shifting towards using less and less inorganic fertilizers and more and more natural alternatives. They are shifting toward natural alternatives like organic fertilizers, like putting back organic matter into the soil, like doing forestry, and all these factors. Now, this can hamper the industry which was pre-existing, right? And this can in turn hamper the value chain of this industry. For example, inorganic fertilizers can be made out of petrochemicals, and petrochemicals may be produced by oil refineries. So all these things can be interlinked, and the entire chain may be under stress for some amount of time. Even though the chain may be necessary, but this can put some stress in the system. And this is what we mean by policy changes impacting the system. Then, new technologies. The next way this can happen is new technologies, new products or new services. Now just to take an example, Gen AI is a classic example of new technologies. Gen AI is a classic example of new technologies which is disrupting the workflow. The entire workflow is getting automated at certain levels. And this can impact industries, this can impact employments, this can impact the way the things are done and all these things. We do not even know how many ways this can impact, right? Now in terms of service, I can take an example of the e-commerce industry. During the late 1990s, a company named Amazon pioneered this industry where you can order online and get things delivered at your doorstep. And this was a revolutionary service which actually created a global conglomerate named Amazon. And these kind of changes actually impact the industry, the entire economy in certain profound ways, which can be measurable, which may not be measurable. Example of product can be modern digital cameras taking shape from the previous kind of cameras, right? There are companies like Canon and Sony which are making modern day products, while the other generation, the previous generation of cameras were being built by companies like Kodak. So this was another change where companies evolved and new companies emerged and a kind of evolution took place in the industry. So these are other ways in which disruptions happen or shocks happen to the economy. Geopolitics. A primary example can be application of tariffs. Another example can be geopolitical tensions disrupting trade routes. Another example can be geopolitical tensions hiking the prices of oil because of transport disruption or because of supply demand chain disruption, right? Oil prices can go up. So this is another way in which shocks may occur, right? Natural disasters. Well, natural calamities tend to happen once in a while, and when they happen, they actually tend to impact every sphere of life. And obviously, economics is a part of it. So this is another factor to reckon with. Then comes financial crisis. Now, financial crisis is something which is not a sudden disruption. It generally tends to build up over a period of time. Maybe a prolonged period of high interest rates, very high interest rates, or a prolonged period of very low interest rates or negative interest rates, or a prolonged period of high inflation or a prolonged period of deflation. All these things can impact the financial system or the economic system in very profound ways, and this can be counted as a shock. But this is more of a build up than a sudden shock. Unless there are some certain policy changes or geopolitical changes which are being influenced, which gives a financial shock itself, which creates a financial shock itself. These are generally factors that build up over a period of time rather than shocks. Shocks can also happen. Some policy changes or some geopolitical scenarios, some currency scenarios can actually create a shock also, but generally it's a build up which happens. This creates a financial crisis. And because even if the build up happens over a period of time, the impact can be so sudden and drastic that we can actually categorize it as an exogenous shock. So these were a few factors in which shocks can happen to the growth patterns, and this is what actually creates the cyclicality. Let's move on to the next section. Growth factor decomposition. We will try to decompose the growth factors. So real growth or real GDP, if you want to ask, actually is a function of two things. One is labor input and labor productivity. That is growth in labor input and growth in labor productivity, right? Real growth is a sum total of labor input growth and labor productivity growth. And labor input growth basically is a function of two factors. One is the size of the population, and the other is the number of participants in that population. That is the percentage of active labor participants in that population. So even if the size is huge, you have a low participation rate, that means your labor input is not going to grow. On the other hand, you have a high participation rate, but the size is very small, then also your labor input should be low, right? Then we'll talk about labor productivity. Now, increases in capacity through capital investment. This can actually improve labor productivity. Let's say the amount of labor that is aggregate there in an economy is able to produce 5 trillion worth of goods and services, right? The amount of labor that you have should be actually able to produce $5 trillion worth of goods and services. But because capacity is not there, or the wage rates are low, the current productivity is only 3 trillion. So if the per unit wage rates improve, or if the capacity is improved, then this 3 trillion can actually become 5 trillion, right? So labor productivity is another factor, and capital is something that influences it. Then comes total factor productivity. This primarily means technology. Let's say if you have a port where ships are loaded and unloaded by only manual labor, then it will take a certain amount of time. But if you have automated docking systems, automated loading systems and unloading systems, then it will take maybe 100 times less or 1000 times less amount of time, right? So total factor productivity and capital together influence the productivity of labor, right? And labor productivity and labor input together impact the real growth or real GDP. Now, what is nominal GDP? Nominal GDP is real growth plus inflation. Nominal growth is equal to real growth plus inflation. Now, we will know why we are talking about both real growth and nominal growth in a very short while. Market value of equity. We actually want to devise or decompose the market value of equity into its constituent factors. So here we have divided the market value of equity into 3 factors: nominal GDP, share of profits in an economy, and the price to earnings ratio. Again, nominal GDP, see on the right side, nominal GDP, share of profits in the economy, and price to earnings ratio, right? Let's say at time t, the market value of equity is VT is equal to VET, right? This can be decomposed into a product of nominal GDP at time t multiplied by share of profits in the economy at time t and the PE ratio, that is the price to earnings ratio at time t, right? Now, this is a definition in the short run, but in the long run, does it hold? In the long run, can PE keep on growing? Let's say it is 30 right now. Can it become 300, 3000 and keep on growing like this? The answer is probably not, right? The answer is no. Unless there is some hyperinflationary scenario, this is not going to happen. So this is a no. Share of profits. Similarly, share of profits is a cyclical factor. It will not keep on growing all the time. Let's say it is right now 80%. It cannot go to 90% or 100% and then 110%. It is not mathematically possible or logically possible, right? So, share of profits and P ratio both cannot keep on growing indefinitely. The only thing that can grow in a trend line in the long run is the GDP or the nominal GDP. So, only this one, the nominal GDP, can grow in the long run. So, this is a factor that is very, very vital when we are trying to calculate the growth rate of an entity. It can be a state. The growth rate of a state. The growth rate of a state, a continent, a region, or the entire global GDP, right? So GDP, nominal GDP is very important in that way. Now let's say we want to formulate a way to measure equity returns over a period of time. Let's say from T1 to T2, right? So we want to measure equity return from period T1 to period T2, and this can be for a region, for a state, for a continent, for the entire globe, right? So this will be equal to nominal GDP that has occurred from the period T1 to T2 plus dividend yields, the entire dividend yields from the period T1 to T2 plus the change in the price to earning ratio that happened from the period T1 to T2. Change in price to earning ratio from the period T1 to T2. Right? This is generally a measure in the mid to shorter term. This is not for the long term trend kind of measure. This is for the shorter term kind of measure, right? So from the period T1 to T2, the entire equity returns of a market, of a region or a state or a continent or the entire globe can be measured by the respective nominal GDP added with the dividend yield added with the change in the gross or the aggregate PE ratio, right? Now GDP, this nominal GDP also can be decomposed further, friends. This nominal GDP is equal to real GDP plus inflation. And real GDP again can be decomposed further into labor input plus labor productivity. We have already seen that. So equity returns ultimately is equal to labor input plus labor productivity plus inflation plus dividend yield plus change in PE ratio. This is equity return over a period of time, and this is how we can define return on equity over a period of time on an aggregate basis. Now we move on to the next section. Econometric modeling. What do we mean by econometric modeling, friends? So in the last example, what we saw is there is a 100 years of trend growth rate that is happening, right? There is 100 years of trend growth rate. Now if you zoom in into any sections, which we did, there is a waviness to that trend, right? It was something wavy like this, right? Now to predict the waviness in the trend is basically to predict the business cycle that is part of that trend growth rate. The trend growth rate can be very, very long term, but the business cycle is much shorter in term. It can be 5 years or 10 years or 15 years or whatever. Now predicting these cycles is a very important part of investment analysis and investment decision making, because the better you predict these phases, the better your returns are, because the better decisions you are able to make. So here econometric modeling means basically trying to devise ways of predicting what phase this business cycle is in currently and what phase is it going towards and the timelines of the same. So here there are three kinds of ways in which we try to predict the phase or predict the way in which the business cycle is going towards, right? Let me remove the rough work. These three ways are econometric models. Let me circle it here or highlight it here. Econometric models is one way. Then there is a way of indicators, creating indicators or finding out indicators. Then there is checklist way, which is basically a subjective way incorporating questions and answers of different kinds. Now first, to discuss the econometric models. Econometric models are basically a bunch of equations or rules that are mathematical in nature, and applying them you try to predict where the market is heading towards or where the business cycle is heading towards. Now econometric models can be of two kinds. One is the structural models and one is data driven models with heuristic rationale. What is data driven model with heuristic rationale? Basically you are not trying to devise any mathematical equation which is very, very rigid or robust, but you are trying to do some empirical analysis based on data and based on certain judgments that you have, based on data that is available to you, and the rationale that you apply is mostly heuristic. There is no fixed equation or mathematical principle behind it. It is a data driven approach with minimal application of equation or mathematical theories. On the other side of the spectrum, there is the structural models. Structural models are deeply mathematical and theoretical in nature, and they can comprise of hundreds of equations, hundreds of models, hundreds of structures, and together they form this predictive analytical model. This is based on theory, based on mathematics and all that. And if you try to reduce the impact of theory and mathematics just a little bit, make it lighter, a little lighter, then what forms is what we call reduced form models. So structured form models is the most theoretical or most rigid and robust kind of way of defining the cycles, and if you reduce the theoretical impact or the mathematical impact slightly, then it becomes reduced form models. And if you reduce it further and make it completely data driven and empirical, then it becomes a data driven model, heuristic model, right? These are the three main ways you can do it. Then comes the way of indicators. Now if there is a business cycle, the indicators can be of three kinds. First is the leading indicators. Leading indicators means these indicators predict the cycle before they happen. They predict the cycle before they happen. Then there are coincidental indicators, or indicators which coincide with the phase of the cycle. Then there are lagging indicators, indicators which confirm that certain phase of the cycle has started already, right? Now, the most emphasis is on the leading indicators. So, indicator driven approach is mainly leading indicator driven approach. Then comes the checklist way of doing things. This is basically you have a flexible way of judging where the market is heading by creating question and answers of different kinds. You can use any kind of indicator, any kind of variable, any kind of aspect you can try to explore and fit it in the checklist model. So now all these models have their own advantages and their disadvantages, their own strengths and their own weaknesses. Now one by one we will try to understand what are the strengths and weaknesses of the econometric models, of the indicator models and the checklist models. So let's start. First we'll talk about the strengths and weaknesses of econometric models. Strengths and weaknesses of econometric models. So strengths are, it is very robust. That is, the equations might be defined, the theoretical basis might be defined, the variables, the parameters, everything might be defined. And this gives it a very robust nature. Robust means the platform, or it is very stable in nature. Then the next point is multiple factors can be incorporated in that model. So there can be hundreds of equations, which means huge number of variables can be incorporated with respective parameters. Then another advantage is quickly generates output. If you just put in the inputs in the variables, the output is generated. No matter how huge the number of variables are and how big the number of equations are, once the model is created, you just need to put in the inputs and the output is there for you, right? Quantifies impact of exogenous shocks. Because it is a very complex model, it can encompass the impact of exogenous shocks also. So it can actually quantify what is the impact of a certain kind of change in the policies, in the geopolitics, in the way technology is occurring, in the way the financial system is going, right? So all these things they can incorporate and quantify what is the impact, how much is the impact of these kind of changes or shocks. The next advantage is it imposes discipline on the analysis process. So once you have the theory, once you have the mathematics, you are very particular which way you are going and you need discipline to stick to that. You cannot, this kind of model makes it very difficult to diverge from the basic premise of creating the model. So it imposes discipline on the analysis process or on the analyst itself. Now comes the weaknesses. With the advantages come certain weaknesses also. For example, the models are complicated and take a lot of time to build. Obviously, if you are creating hundreds of equations and numerous variables are there in the model and you are trying to specify what kind of model fits in, is it a linear model, polynomial model, logarithmic model, what kind of model is going to fit in, for example, then it takes a lot of time. So model is complicated and it takes a lot of time. Then data inputs are not easy to forecast. So data inputs are not easy to forecast. Obviously, in the model, all levels of the economics are there. The geopolitical levels are there, the financial levels, the currency levels, the behavioral levels, everything might be there. And predicting all those aspects simultaneously and correctly might be very, very difficult. So that is another difficulty or weakness of this model. Relationships are not static. So the equations that you create may not be parametrically or variable wise consistent all the time, right? The equation may change over time based on policy changes, based on structural changes, etc., based on behavioral changes, etc., etc. So relationships are not static, but your model once created becomes static, and that is another difficulty or another weakness that you face when you are using structural models or econometric models, right? False sense of precision. after you create a precise, very robust theory and very stable theory and stable set of equations, there is a sense of precision which might be false. Empirically speaking, the real world incidents may diverge, right? Econometric models often are not good at predicting the turning points. That is, the market is in a recovery phase and it is going to go into expansion mode soon. This kind of prediction is very difficult to make when you are using an econometric model. Or the market has peaked and it's going to go into contraction soon. This kind of prediction is also very difficult when you are using econometric models. Trending phases are easier to handle when you are using this kind of a econometric model or a structural model. Strengths and weaknesses of leading indicator based approach. Leading indicator based approach. So we say that indicator based approach is basically leading indicator based approach, right? So here the strengths are intuitive and simple to construct, usually speaking. Then focuses on turning points primarily. See, in the previous case we had a disadvantage or a weakness where the turning points were difficult to predict. Here with the leading indicators, turning points become much more easier or much more efficient in predicting. Then easy to track. The data that you require for all these leading indicators can be received from a third party, and that makes it easy to track the data. But with the advantages comes a few weaknesses also. So number one weakness is prone to frequent revisions. Let's say you are looking at previous quarters or previous to previous quarters GDP numbers. Chances are they have been revised multiple times. If you are looking at 10 years of quarterly GDPs, chances are many of them have been revised many times. Now this makes it very inconsistent or unreliable for model creation. Then overfitted. Now once you create a sample of leading indicator data, that is, let's say 10 years of leading indicator data you have with yourself, and you try to predict something, let's say the price of stock index with it. Now you create a model out of it. The thing is, the sample is overfitted because you are using a particular sample there. The future may not match with the past. The future may be different than the past. And therefore, when you try to apply this overfitted model into the future, that is in the real world scenarios, it may not exactly match, it may diverge. So overfitted model and divergence is possible from the real world situations. Can give false signals. Indicators can give false signals. Let's say the theory says that yield curve inversion predicts a market correction. Now this is a leading indicator you are trying to use, which may not always apply. It may give false signals also. You may predict that the market is going to correct and reposition your investments, but ultimately find that the markets have not corrected because there are so many factors which have not been accounted for in this analysis. So this can also happen. Not much more than directional guidance. This is the fourth disadvantage. So they can say there is a turning point upwards or a turning point downwards very well, more often than not. But quantifying it or putting a time horizon in it, these indicators are not so good at that. So this is another weakness. Then comes strengths and weaknesses of checklist approach. Checklist approach. So we'll talk about this checklist approach, which is basically a subjective approach. It is created through a set of questions and answers which can incorporate anything from any aspect, from any dimension. Behavioral, economic, fundamental, technical, anything. Geopolitical. Now let us look at the strengths of this. Limited complexity. Obviously you are looking at a lot of factors, but you are not looking at creating equations out of them or trying to create structural models out of them, right? You're just trying to create questions and answers to create a judgment for yourself. What is going to happen, how much of it is going to happen, what is the intensity, etc, etc. So here the complexity is limited compared to econometric model, right? Then flexible. Obviously any aspect can be incorporated in the model. In the checklist model, any aspect can be incorporated. It can be behavioral, it can apply alternative methods which are non-technical and non-fundamental, and that's why it is very flexible in nature. Breadth is broad. Obviously huge flexibility, huge breadth, any topic you can incorporate in the model. But with them comes a few weaknesses too. First is subjective. Subjective means it is arbitrary. Arbitrary means your own judgment is required. The analyst's own judgment is very important here. Then time consuming. Obviously a plethora of factors have to be reckoned with, which makes it time consuming. Manual process. We are not using automated systems which creates outputs from equations. We are trying to analyze manually. This has limits to the depth that can be applied, right? Thousands of variables may not be incorporated in it. There is a limit to the manual process. Then, bias and inconsistencies. Obviously, with subjectivity, with manual process, biases and inconsistencies may creep in. Because the breadth is so much, inconsistencies can creep in. So these are the weaknesses of checklist approach. Now friends, leading indicators, we have already understood their strengths and weaknesses. Sometimes leading indicators are used in a composite form. That is, a lot of indicators bunched together to give a certain indication upwards or downwards. These are called composites. And these composites, one kind of it is called the diffusion index. This is basically a combination of multiple leading indicators, leading economic indicators to indicate where the market is heading towards. So this is a combination of leading economic indicators. Combination of leading economic indicators or LEIs. Now one thing we have already understood is they have certain disadvantages like false signaling and frequent revisions of basic data, right? Now to avoid this or to minimize this, there is something called nowcasting. Nowcasting is basically, let me give you an example, there is something called GDP Now, which tries to predict the GDP of the current quarter, this quarter, based on the data that is coming through to the Federal Reserve. This is called GDP Now and it is based on current data. This quarter's data you are trying to use to predict the GDP of this quarter itself. An advantage of this nowcasting is the data is not prone to revisions that much, right? But there are disadvantages also. Disadvantage like these are not predictive beyond a quarter. Beyond the quarter, there is no predictability of these kind of processes. Then there is the second point where it is very volatile to begin with. From the beginning of the quarter, this data is being reflected, but it is very volatile to begin with. And by the time it stabilizes, a lot of the information and a lot of time has already passed. So the predictive advantage of this is highly lost. So volatile for the initial part of the quarter and delayed stability, which takes away a lot of predictive advantage of this process. But one thing is, this data is not prone to revisions that much. Business cycles, their reasons and their implications. So friends, in the trend analysis, what we discussed was a 100-year-long period of GDP numbers, right? We took an example where we were plotting an imaginary 100-year GDP number of a nation. And what happened is we found that in this example, the trend line, that is the long-term line which passes across all these decades, has a predictable trend. But there is a waviness in the short term to it. So we zoomed in one section and this section showed some waviness here. Now business cycle is basically this particular waviness. This particular waviness you can call as business cycle. Now what is this business cycle and why does it occur in the first place? So friends, in the markets there are various factors. There are various factors like population, like monetary policy, fiscal policy, geopolitics, bank credit, supply and demand, consumption, capital expenses, technological developments, behavioral cycles of people. All these things are there which combine together and give us this waviness. And this waviness we term it as a business cycle. Now this business cycle has inherent factors also and external factors also influencing it. So what are the external factors? External factors are factors like geopolitics, global economy, technological developments or technological breakthroughs, policy changes, natural happenings, etc. etc. These are external factors and they come along with certain cyclicalities which are a combination of both external and inherent factors. So there is the currency and monetary cycle, for example. Now when the markets are going through tough times, monetary intervention is done. Quantitative easing, for example, was a monetary intervention. Low interest rates, negative interest rates, zero interest rates was another kind of monetary intervention. Then when the inflation rates went up recently up to 7%, 8% in USA, the interest rates were notched up. This was another kind of monetary intervention. So this was a policy matter combined with the inherent characteristic of the cycle. Basically, the cycle was exhibiting high inflation, so the policy had to intervene and reduce the inflation or take action to reduce the inflation, which caused the monetary cycle. The monetary cycle was basically a zero interest rate period followed by high interest rates. So this is currency cycle or monetary cycle. Then comes fiscal cycle. Again, due to certain reasons, if the markets inherently seem to slow down, then the government may think of reducing taxes, or the government may think of increasing its spendings. So this again causes the fiscal cycle. Then comes the credit cycle. Credit cycle is basically banks expanding and rationalizing their balance sheets in a cyclical manner. Let's say when the markets are going through good times or smoother times, then the banks expand their balance sheets. Ideas are invested upon, consumption is invested upon, education is invested upon, infrastructure is invested upon, businesses are invested upon, individuals are invested upon. Like this, the balance sheet of banks expand. Then after a certain period of time, it can be 10 years, 15 years or whatever, then the banks see that certain ideas, certain individuals, certain businesses are not performing to the extent that was expected. So loans turn bad, that is non-performing assets accumulate. And when this number goes up to a certain threshold limit, then the banks think that we have to rationalize the balance sheet. Then again a rationalization period happens when the banks reduce their credit expansion or contract their credit expansion, right? This kind of behavior happens in a cyclical manner. This is again a combination of inherent patterns of requirement for loans, and which is followed by non-performance of loans, which has to be rationalized. This is another credit cycle. Then comes supply and demand cycle. Customers buy different kinds of products. Some are durable products, some are consumable products, some are required on a recurring way, some are required once in a way, right? Like real estate is like once or twice in a lifetime kind of a purchase. Then electricity bills are a recurring cost. Gas bills are a recurring cost. Then a refrigerator is like a 3-year, 5-year or 7-year cost. So there are different cycles depending on different products, and hence supply and demand also goes through different cycles, and these cycles intermingle together to give what we call the supply and demand cycle, right? Which means different products and services go through different levels of demand cycles, and this demand cycle the supply side has to follow. So supply and demand both go in a cyclical manner, and as supply and demand keep on going in a cyclical manner, the capex also happens in a cyclical manner, because companies try to expand and eventually they may end up over expanding, and then they may have to rationalize. So this also creates capex cycle, that is a period when expansion happens, then a period when rationalization of this expanded capacity happens, which means you do not expand further, you just wait for the capacity utilization to go up to threshold limits. Then comes the behavioral cycles. Human beings behave in certain patterns. In certain ways, they react to the markets and their professional standings. So when things are going well, consumption happens in a much better level. But when things become tough, people start to rationalize their expenses, people become negative towards the markets, and all these together may lead to a cyclicality in what we see as the stock market cycle. Right? Stock market cycle seems to be the very evident or the extrovert portion of all these cycles that we talk about. Everything else can happen in a technical way, in a way in which the domain experts will know, but stock market cycles we all get to know. And this is basically the collective behaviors of people which is triggered by the actual scenarios in a lagged way or in a leading way are reflected in the market cycles, right? This is a reflection of the market's actual position combined with the behavioral response to that actual position. This is what we see as the stock market cycle. Then comes the competition cycle. Competition cycle, let's say a new technology develops, right? In the beginning, only 1 or 2 or 3 companies at max are developing that technology. Maybe artificial intelligence, maybe some other kind of technology, whatever. Now, during the initial stages, growth is very high, the margins are very high, there is huge amount of scalability in it. But then, with time, as more and more competition starts to happen in this technology, the industry matures, the competition increases, the profits get slashed. So this also creates a cyclicality where initially the growths are high, the margins are very high, then it may so happen that the margins are reduced and the growth is also hampered, or growth also becomes a matter of great competition. So this creates the competition cycle. Then the consumption cycle. We already spoke about the consumption cycle a little bit, but let me elaborate it once again. The people are buying different products which are required at different intervals of time. And these intervals combined with the economic scenario as a whole creates what we call the consumption cycle. These cyclicalities which are inherent to the markets combined with the external factors gives result to what we know as the business cycle. These combined give us the business cycle. Now this business cycle basically has certain phases. First some recovery happens, then expansion happens, then peaking of the expansion happens, then again slowdown happens followed by contraction. Again recovery happens, again expansion happens, again peaking happens, again slowdown and expansion happens. This happens in a cyclical way, although because the business cycle is a combination of multiple other cycles, like we spoke about a few cycles here, because this business cycle is a combination of multiple other cycles resulting in a business cycle, the cyclicality or the periodicity is not consistent. Sometimes it may happen in 8 years, 10 years, sometimes it may take 15 years, sometimes 20 years, sometimes less than 10 years, sometimes 5 or 6 years, etc. etc. This means that timing this cyclicality or understanding which phase of the cycle we are in currently is a much more difficult process. So let us try to understand what are the characteristics of the different phases of a business cycle. Phases of a business cycle. So friends, we have tried to draw a typical cycle here which consists of 5 of the following phases. So friends, here we have tried to create a picture of the phases of a typical business cycle. First, the business cycle begins with the initial recovery phase. Initial recovery happens. Then this is followed by the early expansion phase or the early very good times. Then the early expansion phase is followed by the late expansion phase, which has certain other characteristics. Late expansion phase is followed by a slowdown where growth actually stagnates or goes back to zero. Then that is followed by a phase which has negative growth. So here, if you want to understand what this vertical axis suggests, this actually suggests the growth. So the growth has a baseline of 0 here, and anything above this is positive growth, and anything below this is negative growth or degrowth. So this is what happens here, and the horizontal axis is obviously time. You can say this is time, right? Now the initial recovery, the early expansion, late expansion, slowdown and contraction. These phases have their unique characteristics at different levels. At the level of fixed income, at the level of bond markets, at the level of equity markets, at the level of asset prices, real asset prices, at the level of policies, everything is different. At the level of consumption, capital expense, everything is different. So all these factors and how they behave in each of these individual cycles, we will try to understand here. So these behaviors of individual phases of a business cycle we will understand here. So let's begin. So friends, we'll start with the initial recovery. What are their features in terms of consumption? What are the features in terms of capital markets? That is, what are the prices or what are the behaviors of different assets? These things we'll understand. So we have already said there are 5 phases here. So our first phase is initial recovery. Then there is early expansion. Then there is late expansion, then there is a slowdown, and which is ultimately, unfortunately, followed by a contraction, right? So we will start with the first phase, which is the initial recovery phase. What happens here? First, the output gap is still negative. What do you mean by output gap? So what happens is expansion happens during expansion cycle, not only in consumption, but also in business capacity building. Now, this expansion can often overshoot the requirement during a slowdown or contraction. In fact, most probably it does. So what happens during a contraction phase is the consumption slows down and goes into negative growth territory, and the businesses in response delay their equipment purchases, delay their inventory purchases, and as a result, there is a negative gap between demand and supply. So during the initial recovery, what happens is the demand picks up, but companies are yet to fill up their inventories adequately. The capacities are underutilized, and even sometimes capacity buildup is not there, right? So this is what creates this negative output gap. Then what happens? Inflation is still slowing down. Inflation is still slowing down. So even though the economies are recovering, it may so happen that the inflation is still slowing down. It is not yet on the rise, right? Then spending begins on real estate and durables. So as I said, a real estate is a once in a while purchase and a very, very big ticket size purchase. One can only purchase this when the finances in the long term future are seeming to be certain, at least for the next 5 years or 10 years or whatever. These kind of purchases are generally made by individuals when their financial condition and outlook is generally stable. But during a contraction, what happens is the financial situation of individuals in a collective way becomes unstable, comparatively speaking, right? And as a result, what happens is people delay their real estate purchases. And so goes with their durable or consumer durable purchases. If there is an air conditioning to be bought, if a freezer is to be bought, if a car is to be bought, all these things also can get delayed during a contraction phase. And during the initial recovery phase, these purchases restart. So this is an indication of a initial recovery, friends. Then let us talk about the capital markets. What happens to the capital markets? During a contraction period, states usually ease the monetary policy, which means lower interest rates for a sustained period of time. Now, this can continue even during the initial recovery phase. Short-term interest rates may still be low. And what about the government bond yields? During a period of contraction, people take flight or people move their capital to safer assets. And government bond yield is generally considered to be a very, very safe asset. In fact, arguably the safest of assets. So what happens is the prices of government bonds go up, and as a result their yields come down. Now what happens during the initial recovery phase also is that the yields of government bonds remain low. They remain low, right? So government bond yields still remain low. Short-term rates, they also remain low because the policymakers want to be confirmed that the initial recovery phase has begun. So it is also happening in a lag. Now then, yields may continue to fall. Yields may continue to fall, which means people are still looking for safer assets, which means they are going for high quality bonds, and as a result, yields keep on falling because there is more purchase or more purchase power going towards them. Then, what about the stock markets? The stock markets rise. This is a phase when the stock markets see rise in their levels. And particularly, we can see an uptick in the small caps, we can see an uptick in the cyclicals, or we can even see an uptick in the startup, venture funding, private equity and all that. So these are indications of initial recovery phase, right? Now, after the initial recovery phase, there is the next phase, which is the early expansion phase. What are the characteristics of that phase? Let's discuss that. So what are the features of an early expansion, friends? In early expansion, the output gap is still negative. It is still negative, but the gap is narrowing. Means people are buying their capacities and they're investing. Meaning people are investing in capex and people are also growing their inventories. So capex and inventory growth is happening during this time. Capex and inventory growth is happening. Output gap is still negative but narrowing down, right? So this is the first characteristic of early expansion phase. The profits start to rise. The profits are also now clearly rising. The performance numbers are going up. Then there is further uptake in real estate spendings and also in consumer durables. And what about the capital markets? In terms of capital markets, the short-term rates for the first time show signs of rising. That is, the central banks become aware that the early expansion phase has arrived, the recession is over, the contraction is over, and we are in early expansion phase. So some rationalization is required. So short-term rates are intervened upon and a little bit of increment is brought upon in that phase. Long-term rates are not touched, they remain stable. They are kept stable. So short-term rates are going up, long-term rates are stable. This means what? The yield curve is flattening. It was very steep during the early expansion phase. It was very steep. Now it has become a little flatter. The angle has reduced. That's all. But it's still steeper than what it is in a peak phase or a slowdown phase, right? What about the stocks? The stocks are actually rising. At all levels, the stocks are rising and trending upwards. Now, what happens during a late expansion phase? Let's understand that. So friends, in the late expansion phase, the first thing that is observed is output gap is no more there. The output gap is closed. That means capacities are utilized, capacity expansion is sufficient, inventories are sufficient. Then, not only that, there is actually chances of overheating in the markets. That is, capacities may have gone beyond the future demand, or people may be purchasing more than they require, they may be taking too much leverage than they can manage, etc. etc. There is a general euphoria in the markets. Debt levels rise, which means leverage is there at all levels, at corporation levels, at individual levels, even at the sovereign levels, debt levels may rise, which may increase the risks. And higher risks means higher volatility. So what happens in the capital markets, friends? In the capital markets, the short-term rates keep on rising because central bank knows that this is the late stage of expansion, which might be followed by a slowdown, which might again be followed by a contraction. So the rationalization is required, which means short-term rates have to rise. So short-term rates keep on rising, driven by central bank policies. The bond yields are also rising. So during late expansion phase, what happens is riskier assets, lot of funds get diverted to riskier assets. So the bond yields rise. But this rise is less slow than the short-term rates rise. So which means the yield continues to flatten further. So the yields continue to flatten because even though both long-term and short-term yields are rising, the long-term yields are rising slower than the short-term rates. So the curve becomes even flatter. So the angle reduces further. Right? Then what about the stocks? The stock markets are still rising. Often it is still rising, but with volatility, especially stocks which are small caps or cyclicals, they show higher volatility and underperform. Right? Now what about the slowdown phase? The late expansion phase gives way to the slowdown phase. What are the features of it? Let's discuss. So the slowdown phase features, what are they? Firstly, investment options are less. Fewer good ideas to be invested upon. That is the first thing. The leverage has accumulated a lot and there are high debt levels all across the board. Then there is high inflation which started picking up during the late expansion itself continues to rise further. Therefore, costs rise, putting pressure on consumption. Capital markets. What about the capital markets? Short-term rates are still rising because the central banks want to be sure that overeating and inflation spirals do not happen. So short-term rates are rising, but they might be nearing peak. Then bond yields go down. Because suddenly everybody is trying to invest in safer assets. High quality bonds qualify that criteria and people are putting their funds continuously in them, thereby reducing the bond yields. Which means yield curve may invert. Right? It can invert. Short-term rates may go upwards. Credit spreads widen. Obviously, because everything is taking flight towards higher qualities and consumption has gone down, business conditions, economies have
business conditions and economic conditions have deteriorated, many of the debts have become riskier. So credit spreads have widened. Stocks may fall. Apart from a few very defensive sectors like utilities, other sectors may actually fall. Now, post this slowdown comes the phase of contraction or probable negative growth. What are the features of that phase? Let's discuss it. So during the contraction phase, there is uncertainty at all levels, right? Which means spendings go down. Spendings go down. Production of businesses go down, they are reduced. Inventory levels are reduced. Capacity utilizations are reduced. Expansions are halted. Equipment orders are postponed, and all these things happen. Profits start going down. Not only profits go down, losses may happen, bankruptcies may happen, frauds may become revealed, and all this happens during a correction phase very often. And all this very often happens during a correction phase. Unemployment rises because businesses are not able to sustain the costs. Unemployment generally may rise. What about the capital markets? Short-term rates, the central banks realize now is the time to start dropping them. So, short-term rates start to drop. They start to drop. Then stock markets, obviously, they also start to decline. And decline can be a very polite way of saying this. There can be a stock market crash also, right? Credit spreads widen and remain wide. So if there is a contraction happening, obviously consumption all across the board is coming down at all levels, which means servicing the debt has become much more riskier, much more uncertain. So credit spread widens and remains wide till the time signs are there that the recovery has started to happen. But at the end of the contraction phase, something happens with the stock market which is positive, which means the stock markets start to rise. Well before the actual economics start to develop or become healthier, the stock markets generally show signs of rising up once again. So these are the 5 phases of a typical business cycle. Now we'll move into the next section where we'll talk about the relationship between capital markets and business cycles, relationship between capital markets and inflation, relationship between inflation and business cycles, and all of that. So let's start. Business cycles and capital markets. Now there are multiple factors of interaction between a business cycle and capital markets, and obviously because capital markets are the avenue through which investments happen generally, so investments and business cycle are correlated. Because investments and business cycles are related, obviously the capital market as a whole is related to business cycles, but there are certain limitations to it and caveats to it also. So we'll discuss a few of them here. First thing is, the phases of a cycle may vary. The phases of a cycle may vary. What does this mean? Take for example, a dot-com bubble happens in 2000. Then the financial crisis happens in 2008. After that, in 2025, we are seeing signs where there can be a correction. It may not happen, but it may also happen that a correction is happening right now. Right now, we are sitting in the middle of a correction. It may so happen. So, if you see the distances here between 2000 and 2008, it is 8 years. And between 2008 and 2025, it is 16 to 17 years, right? So the phases can vary. The cyclicality is not uniform or very, very periodic, very, very predictable. It's not like that. The periods may vary. Then, difficult to distinguish cyclical impact and secular forces. Difficult to distinguish cyclical impact and secular forces. Secular forces means, so there is a very thin line between what is cyclical and what is secular or natural, right? Two things that can be done with choice. One is the monetary cycle, and second is the credit cycle. Banks can choose to expand credit or rationalize their balance sheet. Authorities or the state can choose to increase the money supply or decrease the interest rates, or increase the interest rates and decrease the money supply. These things can be chosen to do. Rest of all is a kind of a response, collective response of individuals in a state. So what is cyclical and what is secular has very thin lines, because if you have the point of view that all market corrections are secular, that point is true but not entirely, right? Because markets are intervened
through state intervention in monetary policies, fiscal policies, and also through credit cycles by expanding credit and rationalizing credit. So there is a chosen response also to the markets. And on the other hand, if you say that the cyclicality is a matter of choice, then also it is not completely true, it is partially true, because the response of monetary supply and interest rates and credit cycles are basically a response to whatever the market conditions are. So it is an interaction between cyclical forces and secular forces. By secular, we generally mean the collective response, and by cyclical, we mean the chosen responses. Even the production reduction. So we can say it is an interaction between cyclical forces and secular forces. And there is a very thin line. There is actually no clear definition between what is cyclical and what is secular, right? Then, correlations inconsistent on a broader sense. Yes, you can say that there are direct relations between business cycles and investments. But what will lead to what? You do not know. Maybe in a business cycle which is contracting, an investment opportunity may arise which is very attractive. Or maybe in a peak phase of a cycle or a late expansion cycle, some investment idea can be there which can be very, very lucrative even after you have invested in the late expansion phase. That can also happen. So correlations are there, but it is very inconsistent. And the larger the ticket sizes get, the larger the investment corpus gets, the less you can define the consistency. Inflation and business cycle. Relationship between inflation and business cycle. Now friends, there are two ways we can understand the relationship between inflation and business cycle. One is by assuming that inflation is only dependent on demands of the market, and the other way is assuming that inflation is only dependent on the supply available in the market. So let me bifurcate them, and then phase wise let's understand what's the impact on the markets and on the inflation rates. Inflation, let's say, is I. In the first case, case 1, we assume that inflation I is dependent only on the demand. That is, it is a function of the demand. If this is the case, then what is the impact of the business cycle on inflation in different phases? Let's understand that. Let me write down the different phases of the business cycle first. So here are the different phases, friends. First is the initial recovery, then early expansion, then late expansion, slowdown, contraction. And ultimately, based on the behavior of inflation at different business cycles, we'll make a conclusion whether this inflation is pro-cyclical or counter-cyclical. So let's go one by one. First, initial recovery. Initial recovery means demand is increasing. Now we are considering supply has no impact on inflation, right? Supply has no impact, demand is increasing. So supply has no impact and demand is increasing. This means what? Initial recovery is good. So supply has no impact and demand is increasing. This means what? Inflation is rising. During initial recovery, inflation is rising. Early expansion. Again, demand is increasing further. Demand is increasing further at all levels. You have seen that durables purchase also increases, real estate purchase also increases. So demand is increasing, which means inflation is also increasing in early expansion. Late expansion. Late expansion means demand is still rising. People are still buying real estate. People are still buying durables. Consumption as usual is happening. So demand is still rising, which means inflation is still rising. And inflation is only influenced by demand here. So inflation is also still rising. During slowdown. Now during slowdown, what happens is purchases happen but at slower rates. So inflation still is there but growing less. If it was growing at 5% or 7%, it is now growing at maybe 2% or 3% or 1%. So it is growing less. Then comes the phase of contraction. During contraction, there is degrowth. Here, inflation is negative, which means mild levels of deflation can occur. So the conclusion, what is the conclusion, friends? The conclusion is, if demand is the only driver of inflation, then inflation is pro-cyclical. Pro-cyclical. That means when the markets are expanding, inflation is going up. When the markets are contracting, inflation is going down. Now what happens if inflation is dependent only on supply? Instead of demand, it is only dependent on supply and not at all on demand. What is the case then? What happens then? Let's understand. Second case, inflation I is only a function of supply. Only a function of supply. That means during contraction, let me start with contraction. During contraction, what happens is production is reduced, capacity is reduced, the availability of products is less. And if inflation is only dependent on supply or availability of products, that means if availability is less, that means inflation will rise. Less availability, price of the product should go up. So in contraction, if inflation is only dependent on supply, then it should go up. And the reverse should happen during initial recovery, because production capacity is being added slowly, which means availability is increasing slowly, which means inflation should come down. Because availability is becoming more and more, inflation should come down if supply is the only thing that determines inflation. Then during early expansion, what happens? Again, more production is being added, more capacity is being added, which means products are becoming more and more available, which means products are becoming more and more available, which means inflation should come down even further, because we are saying supply is the only thing determining here. Availability more means inflation is less. Same goes for late expansion. Production is being further added, expansion is further happening, so availability is further increasing, which means inflation is falling further down. During slowdown, production and capacity overshoot, which means availability overshoots, which means inflation is likely to come down further because availability is much more. Here remember, again we are assuming that supply only determines inflation. So in these two cases, contrary effects happen. In the second case, what happens is inflation turns out to be counter-cyclical. Counter-cyclical. But by the way the markets behave, we can easily observe that both supply and demand influence the markets, and actually demands have greater influence in the markets. They have both influence on the inflation, but demand seems to have greater impact. So we can conclude the impact of demand dominates the impact of supply. Now, inflation and capital markets. We have spoken about inflation and business cycles. Here we'll discuss how are the different asset classes impacted by different degrees of inflation, namely deflation, normal inflation, hyperinflation. Let me first categorize inflation into three kinds: inflation, deflation and hyperinflation. So what happens to bonds during inflation? That is normal levels of inflation here we are talking about. You are getting a constant amount of coupon, and the money that you are getting is getting depreciated due to inflation. So it is actually not so good for bonds. The value of the coupon that you are getting, or the value of the fixed amount that you are getting in the future, is actually dropping. So it is not that good. It is not that good. What is the impact of deflation on bonds? The currency or the coupon that you are getting is actually appreciating in price. While stocks are falling, the coupon that you are getting at a certain currency is actually hardening or becoming more and more valuable. So your bond value, or the value of the coupon that you are getting, is actually rising. So deflation is a good situation to have for a bond. But here there is a provision that interest rates should not be negative. Only when interest rates are not negative, that is lower bound is zero, then only bonds are attractive during deflation. Otherwise they are just a component of the real interest rates. Hyperinflation, obviously not at all good. It is not at all good. Hyperinflationary scenario and getting 2%, 3%, 5% or 10% of coupon is not something that you want. Now, what is the impact of cash and cash equivalents during inflation? Obviously the cash is getting depreciated, which means it is not a very good scenario for even cash. It is not a very good scenario. Deflation. In case of deflation, the situation is better because the cash you have in hand is actually increasing in value. The purchasing power is increasing. So for cash, it is a better situation. Hyperinflation, again, not good at all. Not good at all. not good at all. What about equity? Now, under normal levels of inflation, equities are generally doing well. So, equity is a good option during inflationary periods. Deflation. During deflation, equities are not a very good option because people are actually in a degrowth mode. The economy is in a degrowth mode. People are consuming less. The businesses are not performing well, which means it is not a very good time for investing in businesses or investing in shares of businesses, which means it's not a good time for equities. Actually, for hyperinflation, none of the asset classes are doing very well. But here you can say, let's say in a country like, if you invest in the stock markets, if hyperinflationary rates are 1000%, your stock market goes up by 500%. So some of your purchasing power is saved. But ultimately, it has still halved, right? So there is no point. In hyperinflation, we do not actually see anything. In hyperinflation, the best solution is actually to create distance at all levels. You go to places where investments have their values intact, right? Now, what about the real assets? Here in real asset terms, we are only discussing real estate. So, let me change it to real estate. So, real estate during inflation grows in value. So, it's a good point. Rents also grow. So, it's another good point. So, we are in a good condition under normal ranges of inflation. But during deflation, rents also come down and property value also falls. So, we are in a negative scenario, in not a very good scenario. Hyperinflation, again, we will not comment on that because it's not a scenario you want to be in at all in any kind of asset. So, monetary policy, fiscal policy, and business cycle. What is their interrelation? Let's understand. Monetary policy mainly has two aspects. One is money supply, and second is the interest rates. Central bank interest rates, or generally the short term interest rates. Now, if there is a contraction or slowdown in the markets going on, what the central bank will do is reduce the interest rate, and also along with that, it may increase the money supply, right? So this kind of a situation we call an expansionary monetary policy. In terms of fiscal policy, if there is a contraction, taxes may go down, taxes may come down, and government spending can increase. This kind of situation again is called expansionary fiscal policy, and both of them can happen together when the market is in a phase of slowdown or contraction, right? Both of these can happen together during contraction. During contraction, both expansionary monetary policy and expansionary fiscal policy can happen. Now, why is this done? Basically, growth of an economy or transactions or consumption, anything depends on the velocity of the money, aggregate velocity of the money. Velocity means what? How fast is money changing hands from one company to the other, from one company to the individual, from one individual to the another individual, like this. What is the velocity? And the government wants to keep this velocity at such a level where growth is happening. Now, when growth is not happening in a secular way, the money supply can be increased or the interest rate can be decreased to increase this velocity. And once the velocity increases, the contraction phase may transform into recovery phase. This is why the focus is on velocity. Whatever the monetary policy and fiscal policies are happening, this is basically targeted at increasing the velocity. Similarly, when the markets are going through late expansion phase, that is when euphoria is there, when there is irrationality in the markets, then also reverse steps are taken. For example, money supply can be tightened. Interest rates can be raised. Taxes can be increased. Government spending can be reduced, and all this together can be done during a late expansion phase. This means in late expansion phase, we can both see tight monetary policy and tight fiscal policy, right? And this is aimed again at the velocity. The velocity is going too much, inflation is going too much higher, so we have to control it, and for that we tighten the monetary policy and the fiscal policy. So both of them are targeted at velocity, and obviously the policy is dependent on the phase of the business cycle we are in. So this is basically how the relationship between business cycle and monetary policy plus fiscal policy works out. Impact of negative interest rate policies or quantitative easing. Generally speaking, too much money supply or quantitative easing and negative interest rates can both result in inflation spiraling out of control. So let me write it down. Negative interest rates plus quantitative easing, which means increasing money supply in the markets, can result in lots of inflation. In the worst to worst scenario, it may actually lead to hyperinflation. But it has not worked out that way. Inflation has remained under control. In fact, USA has only chosen QE, only money supply increment. They have not gone for negative interest rates. And under that situation, inflation has remained under control in normal ranges. Recently, it went upwards and they have again raised the interest rates. And they have raised it to levels where last 20 years we did not see the interest rates. So it has broadly remained under control. Another example is where both negative interest rates and money supply increment have been done. The example is Japan. Here also, inflation has not spiraled out of control. In fact, it has remained quite stable. So contrary to theoretical beliefs that this can lead to hyperinflation or inflation out of control or inflations which are very high in number, it has not happened either in Japan or in USA. But prolonged money supply increment or prolonged negative interest rates, what that can do, we do not yet know. But up till what extent this can continue, we do not know. Only with time we'll be able to know. And obviously USA and Japan both have taken corrective steps. Before something else could happen, they have already taken the measures where their currency is not losing credibility. It is actually appreciating. And if healthy decisions are taken, economic downturns or drastic situations can be avoided. Yield curve and business cycle. So friends, during different phases of the business cycle, the yield curve tends to be different. Let us start with the slowdown phase to understand what happens. During the slowdown phase, the short-term rates are at their peak and the long-term rates lag behind. They lag behind. As a result, what happens is the yield curve inverts. This can happen. And during contraction, which follows the slowdown, what happens is the short-term rates are brought down. The short-term rates are brought down from the peak point. The short-term rates are brought down straight to the bottom, right? And the long-term rates are kept where they are without much of a tamper, which means the curve becomes steep, really steep. So from inverted straight to steep. Now after slowdown and contraction, what begins is initial recovery. And as the recovery starts to happen, the central banks realize that the rates can be increased. The short-term rates can be increased slightly. So what happens is, let's say the rates were initially somewhere here at this point. They are raised just a little bit. The short-term rates are raised just a little bit. And the long-term rates are kept at the same level. They are not tampered with much, right? So here what happens is, as a net effect, the yield curve flattens just a little bit. It just flattens just a little bit, right? Now, after the initial recovery begins the early expansion phase. In that phase, what happens is the central bank raises the rates just a little bit more. So the rates were here, let's say, they raise it just a little bit more, right? And the long-term yields remain the same. They are not changing much. So the curve flattens a little bit more. And the same thing continues in the late expansion phase also. Let's say the rates were somewhere here and they are raised again just a little bit. Now, the long-term yields, they are also rising, but they rise less. Let's say they were here at this point. They just rise just a little bit. So because the short-term rates have risen more, the yield curve net effect is it flattens further. Right? And the rates keep on rising in the slowdown phase also, because inflation might be spiraling out of control, there might be accumulation of too much debt in the system. So all this leads to further increase in rates. So the rates, short-term rates, let's say were here, they bring it up somewhere here. Now the long-term yields are not able to keep up with this rise, and what happens is we get an inverted yield curve. The long-term rates, let's say, are here, the long-term yields, and the curve looks something like this. It's an inverted yield curve during a slowdown phase. So what we see is the yield curve inverts in slowdown phase, then becomes absolutely steep by the end of the contraction phase, again start to flatten. Initial recovery flattens, early expansion flattens further, late expansion flattens even more. Then during slowdown phase it almost inverts. The slope of the yield curve is highest during a contraction phase. It is highest during the contraction phase when degrowth is happening, and then on it keeps on decreasing. The slope keeps on decreasing. So it decreases during initial recovery, decreases further during early expansion, decreases even more during late expansion, and during slowdown it inverts. So this means the slope of the yield curve is counter-cyclical. Right? Now friends, we have spoken about monetary policy and its impact during the different phases of the business cycle and how the central banks control the interest rates, right? Now their response is based on inflation, their response is based on productivity, their response is based on demand, and all of this, if you sum it together, the expression of it can be done in one figure, which is the inflation. So based on the inflation primarily, central banks tend to change their interest rates, or the short-term repo rates, or the short-term rates as you may call it. Now we have already discussed that the trend growth rate of a developed market is quite stable, and even in emerging markets it is generally stable with certain decreases and increases in slope due to policy changes and etc. But the main objective here is not to create an interest rate which drastically changes the trend growth rate, or which impacts the trend growth rate too much, right? Not to change the interest rate so much that the current cyclicality is far more exaggerated than the trend growth rate. Now how to do that? One way to do that is to apply the Taylor's rule. Taylor's rule says that your policy rate, your current policy rate, depends on a few things. These things are, first, your neutral policy rate. Your neutral policy rate means the rate at which the trend growth rate should be maintained. Obviously, the second factor is your trend growth rate. The third factor is the expected growth rate in the short term. The fourth factor is the expected inflation in the short term. Maybe you don't want that inflation, right? Maybe you want it, maybe you don't want it. And the fourth factor is the target inflation rate, the inflation target that you are looking for, right? Now let's say your trend growth rate is 2%. Your expected growth rate currently, let's say 0%, right? Your expected inflation, let's say, is 5%. Your target inflation, let's say, is 2%. And your neutral policy rate, let's say, is 2%. Now under these conditions, how would you calculate your policy rate? Your policy rate for the current times, which is I star. There is a formula recommended by Taylor. This formula is like this. I star is equal to R neutral plus expected inflation plus 0.5 into deviation of the expected growth from the trend growth, y expected minus y trend, plus 0.5 into deviation of the current inflation from the target inflation. So pi expected minus pi target. So you are taking into account the deviation of the current growth rate with respect to the trend growth rate and the current inflation with respect to your target inflation, and based on that you are trying to decide your policy rate I star. So here in our example, what will be the calculation? R neutral is equal to 2%, inflation expected is 5%, growth rate expected is 0%, trend growth rate is 2%, which means you have a trend growth rate which is higher than the current growth rate. Then again, inflation expected is 5% and the target inflation is 2%. That is, you want a 2% inflation. So the calculation will be 2 plus 5 plus 0.5 multiplied by 0 minus 2 plus 0.5 multiplied by 5 minus 2. So you can easily calculate the value, friends. This is equal to, let's calculate it. You can pause the video and do the calculations. So here in our example, the number that you want is 7.5%. 2 plus 5, 7, minus 1, 6, plus 1.5, 7.5% is your required policy rate for the current times. You're targeting an inflation of 2% and your trend growth rate is 2%. Your expected growth rate is 0% in the short term, and in the short term your inflation is 5%. Your neutral rate is 2%. So based on all this data, Taylor rule tells us that this is going to be the calculation. I star, or your neutral policy rate for the current numbers, for the current situation, should be 7.5%, right? Now friends, till now we have spoken about the monetary policy, the fiscal policy, the business cycle, the yield curves. Now it's time we combined all these things. We try to interlink all these things and bring them together. So let us start with what happens when we combine different kinds of monetary policies with different kinds of fiscal policies. The first scenario is when there is a loose monetary policy combined by a loose fiscal policy. So this means what, friends? This means that interest rates are low, money supply is up, tax earnings are low, government spending is up, right? This means the government is in deficit, the government spending is in deficit, and also the interest rates and money supply are suggesting that money supply is let loose here, right? So this means that this currency or this system of monetary policy and fiscal policy combined increases the risk of the state which is owning this kind of a policy. The risk is increased. That means if you are an investor, you are looking for higher rates of return. That means eventually you are looking for higher real returns or real rates. And because you are also running a loose monetary policy, eventually the inflation may also shoot up. So higher inflation. Right? Now friends, real rates plus inflation gives us the nominal rates, right? Real rates plus inflation gives us nominal rates. So we have a higher real rate and a higher inflation eventually as a result of a loose monetary policy combined with loose fiscal policy. This means what? Eventually we are going to have higher nominal rates. Higher nominal rates. Now the reverse happens when tight monetary policy is combined with tight fiscal policy. Let's see what happens there. Let me bring these points down. Now in the second case, we have a tight monetary policy combined with a tight fiscal policy. This means tight monetary policy means interest rates are up, money supply is low or restricted. And tight fiscal policy means tax earnings are up, government spendings are low. So both cases we have tightness here. This means eventually the markets will require some loosening of the monetary policy and some easing of the tax rates or easing of the government spending also, right? This happens generally, this kind of a situation happens during a market peak when the inflations are high, the growth has become volatile, there is froth in the market, the credit scenario has become vulnerable.
and institutions are looking to rationalize and, if possible, do a soft landing. This is that kind of a scenario where the markets are in a euphoric state, in the late expansion or peaking kind of state, right? So the states have to take these steps during that kind of a situation, because otherwise the inflation itself will go out of spiral. So they have to increase the taxes, they have to increase the interest rates, they may have to reduce the money supply, they may do each of them individually or combine them together. As a result, what happens is there is a reverse impact in the market. That means eventually you have to reduce rates. The markets will slow down, even a contraction may happen, and you may have to reduce the real rates. This means what? From a peak inflation scenario, we are going to see a reduction in inflation. Reduction in inflation, right? And as the slowdown starts to happen, markets start to anticipate that a contraction may ensue. And in addition to that, by tightening the monetary policy and fiscal policy at the right time when inflation is going out of control and there is euphoria and froth in the market, what you are signaling is the financial system, you are trying to keep it healthy and credible and reliable, right? That is a good point for your real return seekers. That is, an investor who is looking to invest in a state or in a country is looking for healthy financial systems. So, a country which is following a tight monetary policy and a tight fiscal policy at the right time before inflation starts to spiral out of control, that kind of a country or that kind of a system gains favor from the investors, and they start to ask for lower returns. They start to ask for lower real returns. And on the other hand, they also expect that because of the slowdown that will be an impact of these kind of tight policies, the rates eventually have to come down. A combination of lower risk due to healthy monetary policy and an expectation of lower rates in the future leads to lower real rates in the future. Lower real rates in the future. Now, low inflation and low real rates. This means low nominal rates. Lower nominal rates. Now, when both of the fiscal policy and the monetary policy are having the same nature, that is loose monetary policy plus loose fiscal policy, or tight monetary policy plus tight fiscal policy, then we can understand or we can determine that the nominal rates will go up or down. We can determine that. Here we have determined it. Here we have determined it, right? Loose monetary policy and loose fiscal policy eventually lead to higher nominal rates, and tight monetary policy and tight fiscal policy eventually lead to lower nominal rates. But this is not so sure or not so determinable when you have a mix of policies. That is, you have a loose monetary policy and a tight fiscal policy, or you have a tight monetary policy and a loose fiscal policy. In both these cases, we have mid nominal rates. Mid nominal rates. And the extent will depend on how you are balancing the tightness of one thing and the looseness of the other, right? The resultant effect will be a balancing or an trade-off of both these things. So it is less determinable, futuristically speaking. Now, the loose monetary policy and loose fiscal policy generally happens during a contraction, right? This happens during a contraction. And tight monetary policy and tight fiscal policy, this happens during late expansion or even slowdown. So here we are able to combine the business cycle phases with monetary policy and fiscal policy. Now we'll move the discussion towards the combination of monetary policies, business cycles, and yield curves. Let's do that. So friends, here we have a chart which we are going to discuss and delve deep into. The first column talks about which phase it is. The second column is the central bank's monetary policy phase wise. Then the money market rates. That is, what is the kind of rates the investors are expecting in 3 months? The money market rates. Then the yield curve. The reduction of the rates and the change in the flow of money in either direction, either the short term or the long term, or from the fixed income to the equity, or from the equity to the fixed income. What kind of dynamics plays out in the yield curve? All these things we are trying to understand here.
So first we'll talk about the initial recovery phase, right? Here the rates, the short-term rates, remember the short-term rates or the treasury rates have bottomed. The banks have brought down the rates as much as they can, and the initial recovery is now starting to happen. The banks are not yet sure that the recovery is happening, so the rates are low. They want to be sure before they start raising the rates, so the rates are at bottom. Short-term rates are at bottom, right? They start to rise slowly once the central banks become sure that the recovery has started to happen, not in the beginning of the recovery cycle, right? So short-term rates are at the bottom. Money market rates, yes, the investors are expecting there is a rise that is going to happen. So the money market rates, that is the 3-month rates, they rise. The 3-month rates, they are rising. Expectation is about rise, right? What happens to the yield curve? The yield curve at this stage reflects an overflow of money in the short term area. So the short term, the yields are very, very low. Short term yields are very, very low, typically at their lowest. And long term yields are much higher because people are willing to take less term risk also during this period, right? They are moderate to high, right? So combining these two, what happens is the curve is very, very steep. The curve is very, very steep. In fact, the steepest amongst all the stages, it is the steepest at this phase. So here goes the first phase. Let me put a line here. We'll move on to the next step or the next phase. The next phase is what? The next phase is early expansion phase. So the next phase is early expansion phase. Early expansion phase. What happens to the monetary policy here, friends? Here, the stimulus is being withdrawn. So stimulus is being withdrawn. Whatever quantitative easing or interest rate stimulus, whatever was being given, that is slowly being withdrawn. Means there is a little rise in rates. The stimulus is going down, that is QE is coming down, amount of QE that is happening is coming down probably. So stimulus is withdrawn. And what happens to the money market rates? It is moving up. It is expected to move further up. So the money market rates are moving further upwards because there is expectation that the rates will rise further, right? Rise further as the markets expand, right? Now, during this phase, what happens to the yield curve? The yield is rising. The short-term yields are rising. It is on the way up, right? Because one thing is banks are slowly trying to increase the rates or at least reducing the stimulus. And people are also realizing, investors are also realizing that the market is recovering. Slowly but surely the market is recovering. So one thing is money is flowing out from these short-term treasuries and it is moving into more riskier assets or longer-term assets. So the yields in the short term are rising. The long-term yields are stable. The long-term yields are stable. So what this means is the yield curve is flattening because on the short end it is rising, on the long end it is stable. So it is flattening. The angle was steepest during initial recovery. It has become lesser during early expansion. Now we'll move on to late expansion phase. So during late expansion, the monetary policy or the central bank monetary policy is becoming further restrictive. It is becoming further restrictive. And the expectation is rates are going to rise further, but a peak is going to happen soon. Rates are going to rise further, but a peak is going to happen soon. So two kinds of expectation. One is further rise, and two is peaking. Soon the peaking is going to happen, right? So the rise is moderate or slower in pace, combining these two factors. So what happens here is the short-term yields keep on rising. The short-term yields keep on rising and the long-term yields
are relatively stable. They are relatively stable. Not that stable, but relatively stable. So which means the yield curve itself becomes further flattened. It becomes further flattened. The angle has become even lesser. Now this leads to the slowdown phase. Once the central banks realize that rate rising and restriction is enough, the markets are now going to slow down and the inflation is going to be under control, the reverse strategy is taken up by the central banks, which means they are trying to reduce rates to do a soft landing. So let's discuss slowdown phase. So what happens during slowdown phase is that the rates peak, right? And the money market rates, there is an expectation that the peak has happened and a decline is coming soon. So peak and decline. Now here one more caveat is, during this phase, tax revenues may surge. Tax revenues may surge. It is during this phase because those who are in the know, those who are in the markets, they are trying to de-risk their portfolios. They are actually taking on the capital gains and the taxes are being paid for those capital gains. So tax revenues may surge during the slowdown phase. And monetary policy wise, there is a peaking of the rates, and the expectation wise, that is MMR wise, there is a peak and decline expectation, right? Now during this phase, the yield curve is either flat or even inverted. Especially it can be inverted at the short term end, right? The curve is either flat or it is inverted. So flat or inverted. This happens because the short term yields have reached their peak and the long term rates have not been able to keep up, generally speaking. So that means it will either be flat or even it can be inverted, right? The long term yields either just about keep up or lag behind. If they lag behind, the yield curve inverts. If they just about keep up, the yield curve remains flat, right? Now after the slowdown phase, obviously we have the contraction phase. Let's discuss that. Now the final phase of business cycle that we are going to discuss is the contraction phase. Contraction phase means here there is degrowth happening and the central banks are hoping for a soft landing. The rising of the rates is necessary to control the inflation, but once you keep on rising the rates and tightening the policies, what happens is the markets are impacted for a certain period of time and that impact is reflected in the form of a contraction. So during contraction, the reverse policies are taken up by the central bank. That is, there is stimulus and the rates are taken down. Stimulus is going upwards, stimulus is being given, added to the system, and interest rates are being brought downwards. And these two actually have intersecting meanings, right? Now, what is the expectation of the money markets? The money markets are obviously expecting a decline here. That is, in the future 3 months, the rates will be lower. Then again, after 3 months, again the expectation is rates may come down further. This keeps on happening till the time the markets are quite sure that the initial recovery phase has been reached. So what it means is the short-term yields keep falling. They keep falling all across the contraction phase. The short-term yields keep falling. And as a result, the curve returns back to its upward sloping pattern. So initially, during the beginning of the contraction, it is slightly upward sloping. Then in the middle of the contraction, it is slightly more upward sloping. And during the beginning of the initial recovery, it is very, very steep. Right? This is how the yield curve behaves all along the contraction phase as the short-term rates are brought down. As the markets also realize that the rates are going to be brought down and the markets eventually get into the initial recovery phase, this is how the yield curve behaves. At this time, the change in the yield curve is most drastic, right? Rest of the time, it is much more slower. During the contraction phase, it can be very, very drastic. Macroeconomic linkages. So right now, whatever business cycles we are discussing, whatever interest rates we are discussing, whatever monetary markets we are discussing, whatever yield curves we are discussing, they were basically confined to the idea of a state or a country, right? But
A country is not an isolated entity. It is part of the global monetary system or the global economic system. And to understand fully the economic implications, we have to understand the interaction between a state entity and the global entity as a whole, right? And for that, we need to understand what are the macroeconomic linkages. Macroeconomic linkages means what is the linkage between a state, the economy of a state, and the global economy as a whole. Now, there are two ways to understand the linkages of a state and the global economic systems. The two ways are current account and capital account. Now, the current account and capital account are like assets and liabilities, right? So, if you have a surplus current account, you will have a deficit capital account. If you have a surplus capital account, you are going to have a deficit current account. Now, what do we mean by current account deficit and current account surplus? Current account surplus means exports are greater than imports. Current account surplus means exports are greater than imports, right? So this means X minus M is positive. Exports minus imports is positive, greater than 0. Now the equation for current account equates this excess of exports with the excess of domestic private savings plus the excess of government earnings through taxes. Excess of exports is equal to sum of domestic savings plus the government savings or government income, excess government income through taxes. Now what do we mean by excess? Excess of exports means exports minus imports. This is equal to excess of saving means savings minus investments, domestic savings minus business investments, plus excess of taxes earnings means tax earnings minus actual spendings of the government, which is given by G, right? So this is the equation for current account. Let me highlight this. So preferably, economically speaking, a country would prefer surplus current account. That is, it should be able to export more than imports. Now, capital account is just the exact counterbalance of the current account. So ideally, economically speaking, you want a deficit capital account. You want a deficit capital account. Imports should be less than exports, which means M minus X should be less than 0, right? This is just the other way of looking at it. X minus M is greater than 0 means M minus X is less than 0. It obviously implies. Now, what if capital account is surplus? If the capital account is surplus, this means that imports are greater than exports. And the equation for capital account is M minus X is equal to I minus S plus the government spending minus taxes, that is deficit spending, right? So, excess imports of a nation, of a state, is equal to the sum of excess investments plus the deficit spending by the government, which is excess of their tax income, right? So if you have a surplus capital account, that means you have higher imports, which is the sum total of the excess investments and the excess government spendings, which means the government is spending more than it earns through taxes, right? Now, if a country is in surplus capital account, what can it do? It can increase the taxes. One way can be tariffs, or it can reduce the spendings, reducing welfare or other infrastructure spendings, etc., etc. They can do that. Or the citizens can focus more on savings, right? The citizens of the nation can focus more on savings, while the risky investments are rationalized. Now, this is how the mathematics goes. But what if we want to subjectively understand what is capital account and what is current account, right? So here it goes. The current account is what your exports are compared to your imports.
And capital accounts can be thought of as a comparison between the foreign investments like FDI and FPI, foreign direct investments, foreign portfolio investments, compared to domestic savings. Domestic savings. This savings, we are talking about both the savings of the government and the domestic citizenry. So we can imagine capital accounts and current accounts in this way. Although mathematically, how it is, we have already seen, right? Then generally speaking, capital accounts are about strategy and influence. What degree of influence, what kind of influence a country is trying to have on the globe, and what is the strategy, what is the global positioning strategy of that state. That is what capital accounts looks at. And current accounts is about how healthy the economics are, how productive the nation is. That is how the current account is looked at, right? Now, these two have to be balanced, and sometimes one has to be compromised against the other. And there are multiple ways in which this kind of balancing or this kind of trade-offs can be done, right? There are essentially 4 ways that we are going to discuss how the capital accounts and the current accounts can be balanced. So this balancing that we are talking about between current account and capital account, we are going to discuss 4 ways in which this balancing is done. Ways to balance current account and capital accounts. So the first way is changes in aggregate income, bringing about changes in aggregate income. If the income of the domestic citizenry increases, then probably they will be saving more. If the savings increases, there will be surplus in the savings. If government saves more, there will be surplus in the government. If they save their tax income, there will be surplus in the government, which means they will have a surplus current account, right? So this is how changes in income can influence the current account. And the reverse can happen the reverse can also happen. If investments are more than the savings, if spendings are more than tax earnings for the government, then it can go into deficit. The current account can go into deficit. Then relative prices. If domestic goods prices are less compared to imported goods, then importing will be less, and in fact if they are optimally priced, their exports can also grow. Not only the domestic imports can come down, the exports can grow too, which can result in a surplus current account. Interest rates and asset prices. Now, if the exchange rates are kept stable and if interest rates are raised, that will bring in capital from foreign markets. There will be more FPI, more FDI, etc., etc. In total, more investments will happen. So, if a country wants that kind of a situation, then this can be done. Asset prices. Obviously, if asset prices are kept reasonable and if exchange rates are stable, that will also bring in investments from global markets. Then comes exchange rates. Now, exchange rates can also be used to balance current and capital accounts. For example, if the domestic currency is devalued optimally, that can boost exports. Because the domestic product will become cheap in the global markets. And if a country is in a position to exert certain amount of influence, it can actually choose to harden its currency or appreciate the exchange rates compared to other currencies to exert that influence. That can also happen. So both these things are possible, and both these things at certain stages can be strategically valid. So the 4 tools of balancing between current account and capital account are the GDP or the aggregate income. If the income increases, probably the savings increase, and which increases the surplus in the current account. Relative prices, cheaper the goods, easier to export. Interest rates, higher the interest rates with stable exchange rates, higher the inflow of capital. Asset prices, obviously lower asset prices, attractive asset prices with stable exchange rates attract global investments. Exchange rates, if you dilute the exchange rate optimally, then it can boost exports. If you harden it, that can help you in other strategic goals. Interest rate linkage with exchange rates. So let's say there are 2 countries, A and B. Now, in the initial condition, they are having unrestricted capital flows and they are having fixed exchange rates which are expected to be fixed forever. Now, in that kind of a scenario, they will have identical yield curves. So let's say we denote country A with orange line in the yield curve and country B with green line in the yield curve. The two countries will have the same identical overlapping yield curve. So, if the capital flow is unrestricted and the exchange rates are expected to be fixed forever, they are fixed now and they are expected to be fixed forever, then the two countries will share the yield curve. If the yield curve in country B is like this, A's yield curve will just overlap this. Right? So two conditions have to be fulfilled. One is capital flows have to be unrestricted and second condition is exchange rates have to be fixed forever. So fixed now and fixed in the future also, right? Now we change the condition just a little bit. The exchange rates are fixed now, but they are expected to be floating. There is risk that in the future, one country may float with respect to the other in terms of exchange rate. In that case, what will happen? In that case, the country with the weaker economics and weaker currency will have higher yields, which means, let's say B is weaker here. So, if A has a yield curve like this, B will have a yield curve which is above A. So, it can be something like this. It may be parallel, it may not be parallel, it depends, but it will be above. The yields will be higher across the board of maturities. Then, exchange rates are floating. And capital flows are unrestricted. In that case, the countries will have independent monetary policies. But this can also lead to higher volatility due to capital inflows and outflows. Now we look at another case where exchange rates are fixed forever, expected to be fixed forever, and capital flows are restricted. In this case, the exchange rates will be stable. And economics can also be stable provided capital inflows are balanced with capital outflows. Large inflows or large outflows can result in pressure on inflation rates provided you are trying to fix the exchange rate, right? For example, let's say the capital inflows are far exceeding the capital outflows. This will put upward pressure on the asset prices and ultimately the exchange rates may have to break or you will face lots of inflation. So this kind of situation can be faced. So when you are trying to restrict the capital flows with a fixed exchange rate, one has to also balance between the capital inflows and the capital outflows. And if they're able to manage capital inflows with capital outflows, the yield curves will be very, very similar. But this scenario is actually unrealistic because if a country is looking to restrict capital inflows and outflows, this means they are looking for an independent economic policy, which means a stable or a fixed exchange rate is not a permanent thing for this country. So this means the second option, that is the exchange rates may be fixed now, but they are at risk of floating, that is more valid. So the first situation actually leads to investor believing that the fixed rate is not going to be fixed forever. This means the exchange rates risk change and the yield curves will diverge. So yield curves will diverge means they will have different interest rates with respect to different maturities. And what if capital flows are restricted combined with floating exchange rates? Now this is the ideal scenario of completely independent monetary and fiscal and economic situations. So this is the ideal scenario for having an independent monetary policy. Ideal situation for independent monetary policy, right? If the internal economics are stable and strong, this is the way to go, that you manage the different industries based on their situation. You try to manage the capital inflows and outflows so that your internal industries grow according to your strategic situation. And because you have a strong economics,
you can manage the exchange rates also. But this last scenario has to be handled carefully because there can be froth. You can be subsidizing a weak industry in your country which does not evolve well. This can be one case. Second case, there can be capital allocation problems. Capital may not be allocated efficiently there. So these kind of problems are there. So friends, that's about it in this chapter. Thank you so much for being with me in this class. See you in the next class.
Thank you so much friends for being with me till the end of this video. If you enjoyed this video, please like the video and subscribe to the channel for more such classes. Share your feedback in the comment section below and share this video with a friend who may find this helpful. For enrollment to practical application courses, internships and CFA curriculum classes, check the description below. Till then, keep watching Finnovation. See you in the next class.